Good afternoon and warm welcome to the first day of FESE Convention, of annual convention of the FESE organization of the European Stock Exchanges. For those who don't know me, my name is Petr Koblic and I'm president of FESE, and I'm also CEO and chairman of Prague Stock Exchange. Of course, this year's convention comes in a difficult time, once again. And it will come as no surprise for those who are familiar with the history of Europe in 20th century that, for me, as a Czech, the horrors we see in Ukraine touches me deeply. It is clear to me that at stakes are values of European, which we hold very deep and dear in our heart. Right of self-determination, freedom, and our democracies. To show our solidarity with the people of Ukraine, FESE donated, alongside with the members, funds to the Ukrainian Embassy in Brussels. We wanted to show our support and we wanted to fund the Ukraine freedom fight, the Ukraine struggle for our values. At this point, I'm honored to welcome to the FESE Convention His Excellency Oleh Shamshur, Ambassador of Ukraine to the Kingdom of Belgium, and I would like to invite him to deliver a few words. Sir?
Yeah, thank you. So first of all, definitely I would like to thank FESE, its members, for this donation. We appreciate that, and we consider this donation as a sign of solidarity with Ukraine. We do need your solidarity. We need solidarity in emotions, and even more, we need solidarity in action. Situation remains very difficult. In many senses, it's still very tragic. The enemy, the Russian invaders, are trying to push forward, to advance, but at the same time, our forces are mounting remarkable and heroic resistance, and that is resistance not simply of our armed forces, but it's also the resistance contribution to the war effort of our citizens. We are facing an existential challenge because the Russians would like to destroy our state. They are engaged in the politics and in action of the genocide of the Ukrainian people, perpetrating horrendous crimes, war crimes, crimes against humanity. But we are also defending our European choice, the choice of the model of development based on shared democratic values, shared with the European Union, and open, competitive economy. But at the same time, the future of Europe, in many senses, its stability, its prosperity, its peace is being decided on the battlefields of Ukraine. So we are Ukrainians defending the future of Europe and our future as a part of the European Union and the part of Europe. And so we do hope that in the coming summit of the European Council in June, there would be a positive decision concerning the granting to Ukraine the status of the candidate country. Definitely we should and we can stop war machine of Putin because now it's really a seminal, a turning point in the history of Europe. So we should not only stop the war machine of Putin, we should defeat it, so that this war machine, Putin regime, does not intimidate anymore neither Ukraine nor the countries of Europe and all democratic community. We can do that, but we can do that only together. So that's why we appreciate the provision of arms to Ukraine, financial and other forms of assistance, and definitely the sanctions. And speaking here to the business community, I would like to stress, to underscore that this moment is the moment of truth, the moment when everyone should make sacrifices. And sanctions should be really punishing, should be definitely designed to stop war machine of Putin. The second thing I would like to mention to the business community, that's my appeal to desist, my appeal to those who are still doing business with Russia, to desist from doing that, because each piece of money you're paying in taxes in Russia, each commodity you're buying from Russia is contributing to fueling the war machine of Putin. The second and final issue which I would like to mention, that we have been already thinking about the recovery of Ukraine. So in the beginning of July in Lugano, there would be a conference related to the economic recovery of Ukraine after the war. So I would encourage all business actors to take part in this conference and in this effort. So thanks again for your solidarity. We need it. And let's work together. We shall overcome.
Perfect. Thank you, Mr. Ambassador. Thank you for these touchy and most important words. It's hard to turn our attention after this seismic speech back to the business as usual and back to the financial business. That's why we gathered here in the end. So allow me to introduce briefly a theme which will resurface during the next 2 days. And this is the value of exchanges for our economy and for our society. Exchanges bring issuers and investors together. That's our major role, and it's our primary market role, which is done only by exchanges. But we have also second role. Those are the secondary market, where we provide efficient price formation, transparency, and basis for risk management. Exchanges drive economic growth, helping create jobs and helping create growth of our economies. This is specifically true for our small and medium companies. We run SME growth markets in various countries, and those are the markets where 99% of the businesses in Europe, by count, those are small and medium, go to seek the capital and to seek diversified investor base. And as we saw during the pandemic, it's important also our role on the secondary markets. In a tough times, like pandemic was, the liquidity flies to the major exchanges and to the major markets, and that's exactly what we saw. Why is that? Because we provide values which we are associated with: accuracy, reliability, and transparency. We often hear question, is transparency so important? Without transparency, we put at risk the integrity of the price formation process, provided by exchanges and trusted by market participants. It delivers the reference price for everyone to trade, delivers more efficient markets, and lowers the cost of capital for businesses. This can only happen if you have buyers and sellers in same liquidity pool under transparent regime and with non-discretionary access. This is why exchanges believe that the proposal for a consolidated tape must be accompanied by adaptation to market structure to avoid close to real-time tape resulting in more execution on dark venues, on the basis of reference price from the lit markets, but to the detriment of the price formation quality. Furthermore, such a tape puts at risk the ability of exchanges to maintain the basic function I mentioned in the start, the primary market. This is specifically true for smaller marketplaces, where exchanges are usually the only ones supporting the ecosystem, where the SME companies are seeking their capital. And therefore, it's also undermined the efforts of the Capital Markets Union. This is a decisive moment for Europe in a whole manner of ways. The decision we take this time will define our global competitiveness and ability to confront the challenges of today and of tomorrow. Competitiveness, indeed, is also the topic of today's panels, with panels covering sustainable and digital transformation, as well as the panel covering CMU. It promises to be a lively day of debate. And with that, I will hand over to our Master of Ceremonies, our Director General of FESE, Riess. Thank you very much.
Thank you, Peter. Thank you, Mr. Ambassador. Slava Ukraina. As said, my name is Riess. I'm the Director General of FESE, and just for some housekeeping, you do have the possibility, there is a comment function on your screen, so if you want to submit questions to us, please feel free to do so, and we will integrate them here into our moderation. And with that bit of housekeeping underway, let me introduce our first speaker, Commissioner Mairead McGuinness. Unfortunately, she's not here in person, but she pre-recorded a speech, and we're very eager to listen to that. Mairead McGuinness.
A very good morning, ladies and gentlemen. I'm delighted to speak at the opening of the FESE Convention 2022. And I want to begin by welcoming your initiative to support Ukraine and to congratulate you on your show of solidarity. You know the Commission's commitment to helping Ukraine. It's impressive to see so many people and organisations throughout business and society share a similar commitment, and they share a revulsion at the horrors we see daily. One of my roles as Commissioner for Financial Services is to oversee the EU's action and work on sanctions, and in particular sanctions implementation. It's clear that the business community is committed to doing the right thing when it comes to sanctions against Russia and Belarus. We're facing this crisis together. A united approach as one European Union has never been more important. We can face crisis if we come from a position of strength and resilience in Europe. We do that by building up the European economy, driven by a globally competitive financial system. And we will need your support as European exchanges to help us. The European financial system is still too fragmented along national lines, and this is a weakness, but also an opportunity. We need to deepen the capital markets union. A strong capital markets union is needed to support the recovery from the COVID crisis and build strong, job-rich economies. We need well-integrated capital markets to support financing the transition to a climate-neutral future. And we need deep capital markets to fund innovation and ensure that we remain competitive in the digital era. Stock exchanges really add value to the CMU project. You sit at the heart of local ecosystems that help companies go public. Stock exchanges are crucial players in CMU that help companies find equity financing. And equity, as a permanent source of capital, is vital for innovation, early stage and high growth companies. Equity funding is also important for investment in new green and digital technologies. As exchanges, you are important to our work because your specific role lies between investors and companies. And you pay close attention to both investor protection and the competitiveness of EU companies. We value your expertise because completing the CMU is not a quick and easy task. It's a matter of making steady progress in all areas where there are still barriers to the free movement of capital. And that is the idea behind our 2020 CMU Action Plan. I want to outline some of our work so far, especially to develop EU equity markets. As major institutional investors, insurers are key to developing our capital markets. With our review of Solvency II, we proposed facilitating long-term investment by insurance companies, particularly in equity. As part of the CMU package in November, we made 4 legislative proposals, including the review of MIFIR and a new European single access point, and I'll come back to that later in my speech. More recently, in May, the Commission put forward the Debt Equity Bias Reduction Allowance proposal, or DEBRA. This proposal will reduce the debt equity tax bias and help incentivise EU companies to raise equity. We're setting up an SME IPO fund with the European Investment Fund. And this would support investment funds targeting pre-IPO companies or investments in SMEs and mid-caps listed on stock exchanges. This year, we're working on a listing act to help companies, SMEs and larger companies alike, access public capital markets. It will include a review of the legislation that affects listings in Europe, including the prospectus regulation and the market abuse regulation. The Commission is also developing a retail investment strategy, and this is about helping individuals to invest fairly and safely in European capital markets. We're also addressing more complex structural issues like withholding taxes and corporate insolvency. These are often named as the main root causes of fragmentation in European capital markets. The Commission is working on targeted legislative action this year to address these two impediments to progress on CMU. All of our work is about supporting deep, liquid, integrated capital markets in Europe, which engage citizens and provide more financing opportunities for EU companies. For CMU to be effective, we need liquid and transparent markets. In November, we proposed a review of MiFIR, the EU's rules for trading infrastructure. Central to our proposal is the creation of a consolidated tape for each main asset class, in particular shares and bonds. The existing regulatory framework increased transparency requirements, which produced a lot of market data. But trading markets remain fragmented, and that means valuable data is still scattered and difficult to access, in particular for small financial market participants. And this hampers the efficiency of our capital markets. The tape is a missing element in the EU's trading infrastructure that will deliver trading data to all investors, big and small. In practice, the consolidated tape will make data about the price and volume of each transaction available close to real time. The consolidation will be achieved by improving data quality and simplifying access to data from more than 400 execution venues across the EU. When it comes to the consolidated tape for shares, as you know, we will first have a 5-year test using post-trade data only. After that, the proposal provides for the possibility that some pre-trade information may be introduced. When drafting the proposal, we made sure to account for the specific situation of smaller exchanges. In smaller financial centres, these exchanges play a pivotal role for listing and price formation. And that's why these smaller exchanges, as data providers, will receive a preferential share of the revenue generated by the share consolidated tape. We want to safeguard this role in a rich and vibrant ecosystem. More generally, for exchanges, the allocation of revenue generated by the consolidated tape will go to markets that operate transparent, pre-trade order books. The consolidated tape is a project that will democratise access to trading information across the EU and ensure that investors get the best execution conditions. It will help boost the global competitiveness of our financial markets because this new tool could have many use cases beyond best execution and could greatly improve how markets function. Transparent trading is an important goal for the MiFIR review. In parallel to the consolidated tape, we've included measures that increase transparency while levelling the playing field between exchanges and systematic internalisers. The proposal also includes a ban on payment for order flow, where brokers get a fee for sending individual orders to certain trading platforms. Now, I know that this proposed ban has been much debated, but we think it fits well in our market structure review because it will help ensure that retail flows are not diverted from lit exchanges where they can contribute to price formation. Finally, the MiFIR proposal also removes the so-called open access regime for exchange-traded derivatives. We wanted to put an end to trading and clearing silos. But we've seen that in practice, open access has not worked as we wanted it to. And it might even get in the way of the development of new exchange-traded derivative products. We know that the balanced compromise in MiFIR might disappoint some of your members when it comes to the creation of a consolidated tape for shares. But all in all, we believe that we have put on the table a proposal that balances the requirements of many varied stakeholders, and that it meets the overall goal of developing more liquid and more transparent capital markets. The Capital Markets Union is about getting investment moving and capital flowing across Europe. It will help money flow to where it's needed, including to support the transition to climate neutrality. Because public money alone will not be enough, we need private investment to achieve our climate goals. Ultimately, sustainable investment is about making the right choices. And to make the right choices, we need good information. We need complete, comparable and reliable sustainability information from our companies. Indeed, sustainability information should be on an equal footing with financial information. The Corporate Sustainability Reporting Directive and the reporting standards that go with it will ask questions of companies on how they deal with sustainability risks, on their own impact on the environment. At the core of the CSRD proposal are mandatory EU sustainability reporting standards, because currently there are multiple standards, formats and expectations, and this is confusing and it's costly too. So EU standards will provide a cost-effective solution for reporting companies. And these EU standards will build on and will be compatible with global standards. In terms of scope, the Commission's proposal is carefully balanced on the issue of which companies should be subject to the requirements. It covers large companies and listed companies, including listed SMEs. Now, these are included because they risk being excluded from investment portfolios if they don't provide the same quality of information as large listed companies. But to ensure proportionality, listed SMEs have a lighter reporting regime, simpler standards, and a 3-year phase-in for the requirements. We're not proposing any mandatory requirements on non-listed SMEs, which is the overwhelming majority of our SMEs. But they will be able to use the SME standards on a voluntary basis. And this should help them deal with the increase in demand for information from company clients, the financial sector, and indeed many other stakeholders. Right now, the Council and the European Parliament are finalising their discussions on the CSRD proposal. In the meantime, EFRAG is advancing on technical work and has recently launched a public consultation on European sustainability reporting standards. These drafts cover the full range of sustainability issues: environment, social and governance. And we encourage all those with relevant expertise to respond to EFRAG's public consultation. EFRAG will seek to ensure the final draft reporting sustainability standards strike the right balance between the information users need and the burden on reporting companies before submitting them to the Commission in November. If reporting is the first pillar of improving the sustainability of companies, then behaviour is the second. So the Commission has also made a proposal for a directive on corporate sustainability due diligence. And this work is led by my colleagues, Commissioner Reynders and Commissioner Breton. We want to help businesses in the EU ensure that their operations and their value chains are sustainable, especially that they promote respect for human rights and that they protect the environment. This proposal would require companies to carry out a human rights and environmental due diligence process. It's about helping companies really embed sustainability in the way they work. This proposal would also require companies to have transition plans. And these would have to show that a business model of a company and their strategy are compatible with the transition to a sustainable economy and with limiting global warming to 1.5 degrees, in line with the Paris Agreement. We're working carefully to ensure that the reporting obligations under the CSRD are coherent with the behavioural obligations under corporate sustainability due diligence. The CSRD will provide companies with common standards for reporting on sustainability, bringing much more clarity to sustainability reporting. And that will help sustainability information be part of the European Single Access Point, or ESAP, that we proposed in November. I believe that ESAP will be a game changer. It will make key information on the financial sector and capital markets easily accessible to everyone at the click of a button and for free. Investors will be able to easily find investment opportunities across the EU. And at the same time, European companies, including SMEs, will get better visibility. And this will help them get more funding opportunities, which will contribute to lower costs of capital. Market participants tell us they need sustainability information to contribute to the fight against climate change and the transition to a more sustainable economy. In just a couple of years, market participants will have much better access to information on sustainability through ESAP. And they'll be able to use that information to inform their investment decisions, which mean they will help us transition to sustainability. I know I can count on everyone involved to work to overcome the challenges to get ESAP up and running as soon as possible. In closing, faced with instability, strategic competition and security threats, the EU is now required to take greater responsibility. In Europe, our strength lies in our unity of purpose and action. There is strength in our economy, driven by our financial system, which can deliver much more. It's my role as Financial Services Commissioner to unlock the full potential of our financial system, to guide its evolution, and to make sure that sustainability is at its very core. And that will be driven by the Capital Markets Union. Exchanges here will play a major role as we continue to deepen European capital markets. So thank you for the opportunity to speak with you today.
Thank you very much, Commissioner. I think this was a very comprehensive speech of many of the topics we will be discussing the next couple of days, today in the afternoon and tomorrow in the morning with a MIFIR deep dive. And I think I was especially heartened to hear, for example, your comments around price formation. And you will have exchanges at your side to guarantee markets that will deliver transparency and integrity. So we very much see this also as something where we will aid the Commission's agenda, hopefully, in bringing better markets for European competitiveness. Next on our agenda is a topic you just mentioned, and that's our first panel of the day, focusing on sustainable finance. But first, we will have a quick video from our sponsor, Euronext, and then the panel will be moderated by Sara Baldi, Senior Policy Officer at FESE, and, she will be our next session moderator. To the video.
Thank you, Rainer, for the introduction, and good afternoon and welcome to all the participants of this first panel on sustainable finance transition into a green economy. I'm Sara Baldi, Senior Policy Manager at FESE, and today we will focus on some of the key topics dominating the EU Green Agenda, and to do so, I'm joined by a group of excellent speakers, starting in alphabetical order with Julie Becker, CEO of the Luxembourg Stock Exchange. Julie is a recognized expert in the field of sustainable finance, and in 2016, she founded the Luxembourg Green Exchange, the world-leading platform for sustainable securities. Ben Grange, CEO of the Individual Investor Federation of Belgium. Ben holds several mandates in the area of sustainable investing and is also a member of the ESMA Security and Market Stakeholder Group. Saskia Slomp, CEO of the European Financial Reporting Advisory Group, EFRAG, the leading EU standard setter, which is now in charge of developing the EU draft sustainability standard. And last but not least, Luc van Steenkiste, Chair of European Issuers. Luc has a long experience as an entrepreneur, is the chairman and board member of several European companies, and is also a member of the sustainability board of EFRAG. So welcome to everybody. So before we dive into the panel discussion, I would like to inform the audience that if time allows, we will have a very short Q&A session at the end, so they can submit questions through the chat. that. Now, without further ado, let's get started. So, the impact of the COVID-19 crisis, the impact as well of the war in Ukraine, the soaring energy prices, but as well the effects of climate change that we see more and more in our daily life, make us realize how important is the transition into a greener economy. So, transitioning to a more sustainable net zero economy is not anymore a nice to have, but is a necessity, as also just said by Commissioner McGuinness. In parallel to the FESE Convention, the Commission is organizing right now the European Green Week 2022, which this year focuses on the European Green Deal, which is the EU sustainable growth strategy to make Europe climate neutral by 2050. So in this session today, we want to discuss how the financial system can support this transition towards a more sustainable economy. And to do so, we will discuss some of the key topics dominating the EU agenda, for instance, ECG data availability, green bonds, sustainability, and competitiveness. So let's start now with what we can call the great data divide. And to do so, I would like to start with Ben, because investors are more and more eager to get access to ECG data. But how we can ensure that they can trust that what they buy is truly green?
Well, there are several research projects ongoing funded by the European Commission, among which the H2020, which looks at the motivation of individual investors, why they actually want to invest in a sustainable way. And I have to say the motivations are very diverse. So it's not all about data. Maybe that's the first thing to say. But it is important that there is a lot of understanding and transparency, because if the labels themselves lose their meaning, then the people don't trust the labels anymore. Like if you go to the supermarket and it has a green sticker on the butter, what does it mean? So in this sense, the importance is to have the transparency, to have the definitions, and to have the trust, so people know in a clear way what they are actually choosing. And to do so, we need a lot of education, we need a lot of definition to say what is impact, what does it mean, what is sustainable, what does it mean. And it is more than just environmental, which seems to take the brunt of the data right now, simply because it is measurable. So therefore, we had a discussion earlier this week where we said, well, we need to measure what we can. We need to evaluate what we cannot. And we look at the industry to help us figure out how to measure these things that we today cannot measure. What is the social impact and what is the governance that we need to subscribe to. So the target, as Ms. McGuinness said earlier, of the European Commission is to the reorientation of flows into sustainable finance. We do this through the taxonomy, through the understanding, of course. The action pack and the roadway ahead is exactly that, making sure that when you ask for advice, that your intent to invest sustainably is understood, is helped, is guided in the right way, and that we do not simply abandon, I would say, scientific logic for political logic, and we'll get back to that later in the discussion. It's very important that we all work on the same basis of what we understand to be sustainable. If that is the road ahead, then the investors will surely follow.
Thank you very much. And building on that, I wanted to ask you, look, what is the right balance then between investor expectation and issuers' needs in terms of managing cost and the administrative burdens? Meaning, how we can ensure that company can deliver the information which is interesting for the investor, and we are not overwhelming both company but as well investor with too much information that at the end might not be so useful.
First of all, I want to reassure Ben that the companies are really having ESG high in their agenda. 99.9% companies that are subject to the new regulation on reporting, they are really active on it. Some smaller ones also, and very small ones do not really know how to handle it. We know that. But the reasons for it, like you said, are very different. For some of them, it's the investors. What do they think about the company? For other ones, it is what is the personnel saying, the people that I have in my company, are they motivated to stay? Other ones will look at the market, the consumers, and how must I say, the contractors, the people, they are the deliverers of products. What do they say, and so on. So there are also people that really are doing it out of simple obligation to act and responsibility in the ESG. So on the motivation side, there is no problem. The problem is on the building of the system, and that's a very difficult one because we are not having an accounting, like in the accounting world, a system that is already working country by country since years and years and years. And when we started to standardize the accounting system 22 years ago, it took us still a hell of a lot of time to become to a standard on something that was already in place. Here we have to build it. And for me, the only way to build it or educate the people is having the standards. And the standards are something that EFRAG is building on. And we hope end of the year to come out with maybe 14 standards. I'm looking at Saskia. She decides on that. That are where companies can look at, and that is what we have to report on. But there are some conditions on those standards, otherwise they will not work. For me, there are three very important elements. They have to be flexible, so companies should not be obliged to report on things they don't consider as being material, because if we have an obligation of telling a hell of a lot in large and in long about non-material items, companies will really go in the black mist. It will not be what we want to have. Second, there is a set of standards in the world that is developed already, and now, happily enough, we have an initiative of the ISSB board, the sister of IFRS, to make an international standard. They are, in my eyes, a little bit slower than EFRAG is doing on the European Union, but they are working also very actively on this. And for me, the condition of our standards in European Union should be that there is no contradiction, that there is a kind of a harmonization, that we are not confronted with things that companies have to respect completely different one way or another. That's the second one. The third one is a very difficult one for companies on the intangibles and the forward-looking information you have to give. If companies are confronted with, in their analysis of finding solutions for some of the ESG issues of their company, they will, in many cases, have to go into innovative projects or to totally new strategies of building something up. So in that case, companies should not be obliged to disclose things that put their competitive positioning in danger. That is, for me, very important. Otherwise, we will, in the whole system, that is a fantastic system for the European industry as a whole, we will make companies in a loss versus the rest of the world. So this is very important. And my message to you, but I have already heard that we are not disagreeing too much with each other. We think both investors and companies have to have the capability of focusing on the most important elements. That's one point, have to talk constantly together and have to accept that it will be an evolutionary system over time. And in the relation and in the talking, we will find the solutions.
Ben, do you want to add anything?
As Luc says, we agree on most of these things. I think the discussion we had is simply saying that the data is not available. In some cases, is a cop-out. You could use estimates, you could use things, but I do agree you should not report on what is immaterial. Yeah. And I think in the end, it's what we say. If everybody reports on the same thing, and with the standards that EFRAG and ESMA and all those that are putting the standards in place, then the roadmap towards a system that we can all accept is quite straightforward, I would say.
Very good. Now, before moving then to Saskia, I wanted to build a bit on what Lucas said about education and asking Julie, what is the role of stock exchanges in helping issuers, but overall market participants in meeting their sustainability obligation? For instance, the Commission just mentioned the ESAP as one of the game changers. Do you agree with this? Do you think it's a helpful tool and will serve the purpose of making the data more easily accessible?
Thank you very much, Sarah, for this very relevant question. I think making the link between issuers and investors, well, exchanges have a key role to play here because we are service providers to capital markets, meeting place between issuers and investors and trying to cater their needs, and that's what we do indeed. For investors first, we try to provide maximum transparency on information and data, and we also ensure indeed education of investors, and we raise awareness overall in our mission to protect them and to better understand the sustainable financial products in which they invest, and to be able to compare one product to another and make sure that they have the information they need to invest properly. For issuers on the other side, we work alongside with issuers to help them accelerate their climate transition, and exchanges are clearly they have a power to influence and to facilitate or prevent market access to funding for those issuers. And we can issue, for instance, new listing requirements, ESG listing requirements. We can help and guide also issuers by issuing ESG reporting guidelines, like most or more and more exchanges are now doing. I think it's almost 65% of exchanges worldwide now that are tracked by the UN Sustainable Stock Exchanges Initiative that have issued ESG reporting guidelines to guide and help issuers on how to report on those topics. And of course, we can also provide assistance in ESG services, not only for new ESG issuers, but also for issuers which want to expand the scope of their funding strategy to sustainable instruments. So working alongside with issuers is also really encouraging them on the climate pathway through tools that exist in the market now to help them measure their positive or negative contribution to SDG, and try, of course, to set up ambitious sustainability outcomes. With respect to your second question, Sarah, with the ASAP, well, I think overall the ASAP should indeed make investment opportunities more visible to European and international investors. The problem so far, as you mentioned, both being clearly that we lack compatible formats. There are lots of data in the market. I remember a panel I assisted a few years ago where it was said that we are swimming in ESG data, but the problem is ESG data are not structured, formatted, comparable, meaningful, up to date. And so this is something which is extremely important to put in place. So having a centralized database is meaningful and will clearly help to boost, I think, the green transition by facilitating access to ESG data, and should help also reduce the data fragmentation in Europe. However, we also need to find the right balance again, and to be cautious of potential negative impacts of ASAP in Europe. So this should be well calibrated, not only for current existing entities, like officially appointed mechanism that endorse this role so far. So we should avoid duplication and ensure consistency, but at the same time also for issuers, make sure that the principle of filing once and proportionality are ensured as well.
Yeah, definitely. So let's move now to Saskia, because we heard a lot talking about standards. So it's not clearly a matter of quantity of data disclosed, but it's a matter of quality of data. And so the work that EFRA is conducting is therefore key to provide comparable, transparent, high-quality data. So we are all busy looking now at the first set of draft sustainability standard that you published, the consultation. But can you tell us a bit more on how the work is going?
Yes, thank you very much, Sarah, and thank you for allowing us to say a little bit about the work we are doing. And I have to say I speak here in personal capacity. I think the Commissioner gave a very good introduction to all the work. She said good information is needed to move to more sustainable investments. And she also used this picture of walking on two legs. So we know that EFRAG is very well known for financial reporting, and now we are moving into sustainability reporting. And both sides are needed to give a full picture of the companies. I think that's what I hear from all of you, that this good information is needed. So like she said, EFRAG is designated as the technical advisor to the European Commission to provide these draft, I have to underline draft, European sustainability reporting standards, because it's the Commission who decides finally on the standards. They will be adopted by delegated acts. and then they will apply directly to companies. So EFRAG makes the proposal, but there is a consultation process in between. And actually, it's our Sustainability Reporting Board, so including Luc, who will decide ultimately what goes to the Commission, like she said, hopefully early November. So a little bit perhaps looking back, reporting and transparency is very important. So we got mandates from the Executive Vice President Dombrovskis to examine actually if it would be possible to come to European standards. But because you mentioned there are so many standards and so on, and I think sometimes they are referred to as the alphabet soup. And of course we have now seen very promising movements that there is a lot of convergence happening at the global level, which as such is very good. Actually, in one of these appendixes that we ultimately published to the report, they did a sort of inventory of a mapping of what existed in the world, and they came to more than 100 sort of standards, frameworks and everything, so to say. Yeah, there's really a lot going on. So the first thing what happened was the CSRD was published the proposal. What's actually quite unique is that we had to work, we're asked by the Commission, invited it's called, to work already on these standards, because normally you wait till the directive is adopted and then the process. But given the urgency, given the Green Deal, we had to move, and the Commission urged us to move, not only on the drafting of the standards, but also on the governance reform side. So that is what we did. And one of the first things we did, and I linked that to transparency, is that we worked on due process procedures, which we finally adopted in March under our new structure. And that's, of course, important that we have a proper due process, that everybody can contribute, so that the standards ultimately have the best quality we can achieve in the limited time period. Let me put it like that, because this is really, really challenging. And I don't know if you follow the debate in the trilogue, and the Commission mentioned November, so there's a bit more time, because originally in the proposal, the Commission had to adopt the delegated acts already in October, which means even shorter, and the deadline seemed to move from 2023 to 2024, but it's still a very, very tight process for us. So like the Commissioner was saying, we have published 13 exposure drafts on the 29th of April with a 100 days due process comment period. So it's really up to all the stakeholders, investors, issuers, others, because it's also sustainability is a much wider range of stakeholders to give their input. But since to arrive at quality, we really need the input of all stakeholders. These standards, draft standards, exposure drafts, I have to say, are prepared by a project task force, which is a multi-stakeholder group. And it's important that we now get the feedback of everybody. Despite the fact it's in the summer, we know it's short, but we couldn't help. We had to count back from beginning of November, and we have to analyze the comments, and we have the board, and we have a technical expert group that all have to discuss and come to the common draft standards. What we also will do is a cost-benefit analysis, because I didn't hear that. I actually thought that you would talk about that, but so to make sure, like the Commission is saying, that we are able to strike a balance between sort of information needs that you want as investors more and more and more, and the cost side for the company. So that is also done in parallel, and hopefully that all together brings it to a good quality. So we are actually at the moment, what I want to say as well, is not working on the sector standards. So the sector standards are not part of the first set, and also not the SME standards. The Commissioner explained the scope. They will be in the second set. We started to work on them. They will be also developed in parallel, because also that process is very tight. So if you want to help us to come to a good quality, then please comment and contribute to this survey tool that we use of the Commission. Thank you.
We will certainly do. And do you think that then this November deadline, it's feasible, or it's still challenging?
Well, we understood that basically there is no real choice, because well, the trilogue is not finished. Huh? So so we don't know exactly what will be there. But what we know is that 2024 will be the financial year that the standards have to be applied. We know as well that there will probably be a condition that the standards has to be available 6 months in advance, and then there is a calculating back. The Commission has its consultations, its procedures, and so on. So we have been given the deadline of beginning of November. So we will do all efforts to make it. But
I don't know if that helps, but from the individual side, we say less is more. We prefer less data that we understand than more and more data that we do not understand.
That's the real problem. If the standards would be the definitive ones that are forever and 3 days, then the timing is not enough. That's absolutely clear. So if the standards are a process of evolution, then maybe it's an acceptable solution. But if you have to look for things that are fixed for the rest of the next 2, 3, 4 years, let's say like that, and you have on the international one, we are not sure what they will really say there in the international one. So we have to find them also at the end of the year and look at them at the same time we are talking about our standards in the European Union, and we have to look at the other ones, and they are not on the table. So it doesn't make it very easy for the moment. So the pressure, would I be in the European Commission, I would give us more time. But it's the European Commission that has to decide, and that's really...
I'm not the European Commission. But I think it's important to say that in this survey tool, so the consultation period, we also ask about priority and implementation dates, because there are perhaps things that are more important than others, so that something can be scaled. And I think in the CSRD itself, there is a provision after 3 years to review these standards. I don't know if that will change in the trilogue, but I guess that will remain, and also to adapt it then to international standards. But I understood we're going to later on to discuss international standards, so I'm not going to mention those.
Exactly. No, we will touch at the end on everything which is the global context. Now let's move to another topic which has dominated the Brussels green agenda over the past months, which is the green bonds, and in particular the EU green bond standard. Julie, the Luxembourg Stock Exchange was a member of the European Commission high-level expert group, and as well the technical expert group on sustainable finance, which originally discussed and suggested the idea of having this EU green bond standard. Is it what is now being discussed in line with your expectations?
Well, let's first remember the high-level expert group on sustainable finance was created in January 2017, so exactly 3 years after the ICMA, the International Capital Markets Association, has released the first version of the green bond principles. And I insisted on principles because at that time it was really voluntary only. It was not a standard, it was only guidelines issued by the market. And it was extremely important at that time for issuers that this remain voluntary. And even not standardized. Now I think that issuers also understand that there's a need of a framework which brings integrity and helps investors also to compare one product to another. But I think we are exactly in the same philosophy that the main objective is really to find the right balance between this high-level ambition we have for this EU green bond standard, a gold standard with 2 post-issuance report, an allocation report and an impact report that is externally reviewed with a list of reviewers being registered and supervised. So really a gold standard. But at the same time, it should also deliver on a workable and not too burdensome and not too costly solution for issuers, which also remain attractive for investors. And that's about finding this right balance between the different stakeholders, which is still discussed today based on the proposal, and especially within the context of the trilogue and the ongoing discussion. One element I just mentioned is the voluntary nature of the standard is really something I think we were supporting at the high-level expert group and the technical expert group, which is extremely key, especially if we want green bond issuers to continue to issue green in Europe, and if you want to boost as a sustainable bond market, we should avoid deterring issuers to use that type of instruments or to use international standards rather than European standards, and make sure so they can align, if they wish to do so, to international bond standards and not only to the EU. This is really key for me to keep the efficiency of the green bond market today. Another element I'd like to underline is also the legal certainty, which is absolutely needed, especially for investors, but also for issuers. So making sure that even if we need also flexibility, but with respect to the taxonomy alignment of the use of proceeds, we need to make sure that the qualification of the green bond will not change in the lifetime of the security. Because, of course, for an investor which invests in a green bond, which is an EU GBS, he needs also to report and to make sure that there's a legal certainty during at least the time of the bond and before it matures. Finally, the flexibility, as you mentioned, I think this is really key as well in this context. Currently, we really need to make sure that even if I understand that the Council is or the Parliament, wanted a complete alignment with the taxonomy, we need to keep a margin of maneuver just to make sure that we remain pragmatic and make sure that, because it will be scientific based, so there will be some evolution of the technical screening standard, and we need to make sure that everybody adjusts and that we all know that transition takes time and we need to start somewhere. So I think because we also there's a urgency, as you just mentioned, so we need to start now and trying to avoid to reach the best solution, like it's the case also for the taxonomy. We need to start somewhere and then to make sure that we can improve the solution. And lastly, I think we should not forget also the impact on the existing green bond issuances in Europe. Lots of green bond issuers already mention or refer to the draft EU GBS, being aligned with the draft EU GBS. So it's also important to maintain, again, this integrity and this certainty for investors in those type of instruments.
Thank you very much. And Luke, from an issuer perspective, what is your opinion on the standard in general on green bonds? Is there appetite from the issuers? Do you think a standard will provide enough flexibility to even create a bigger market, or how do you see it?
I will be probably a little bit blunt, but I think what Julie said in the beginning, the original setup was a good one. A voluntary standard in the green bonds was something that could be a reference, an ideal model, something to be reached one day, but not for everybody. Now, what we see in the trilogue, and certainly how it moves into the direction of the co-legislators in terms of how do we translate all the work that has been done, when we see the fact that we talk about compulsory standard and not anymore on a voluntary standard, the fact that the alignment with the taxonomy is absolutely something that is not discussable anymore on the project or on the business model, makes us say that very little companies will do this or will have an intention to go into that direction. So as long as it is voluntary and it gives flexibility, we will be in. But for the moment, when I look at the bond market, I see no green bond issuing connected to one specific standard in the world. And I cannot imagine that there will be only one specific standard for the whole of the world. So if that is the outcome, then, sorry to say, but there will be very little companies moving to the green bond market with that unique standard. Or we will lose in Europe the access to the creation of such a market, which is an instrument of financing for companies, like it is the banks. So I am worried today. The project is good, but the way it is moving today is not something that makes me feel okay.
I fully understand, and what's maybe also underlined is that at the time the Hashtag was constituted, we were really speaking about the qualification of the projects and the use of proceeds only. Now we're also looking at, and this is really good, by the way, but we are also looking at the profile of the issuer and the sustainability profile of the issue. And this is already embedded in the EU GBS within the framework where the sustainability strategy should be disclosed, which I find good. But now going again a step further with a potential transition plan being mandatory disclosed by all issuers. Again, I think the right balance should be really ensured here, not to deter issuers to issue that type of instrument. And at the end, this should be detrimental or might be detrimental to the growth of the sustainable finance market.
That's my concern.
So Ben, we heard Julie and Luke be quite vocal to have a flexible and as well a voluntary framework. Do you think that this is feasible, or do we risk greenwashing?
Well, first I would like to say that we are very happy to have a place at the table because the end investor was not always part of the discussion. And then secondly, which is really strange, but I agree with both of them, we expect the law, the mandatory part, to be the basis, but we also know that any innovation has to come from the industry. So should there be a minimum level mandatory? We think yes, because otherwise it is too loose maybe. But is it going to be fully led by imposing these things? I doubt that very much because the industry is still finding its way. On the side of the investor, I have to say there is big interest in this type of product, but at the same time, a lack of understanding. There is still a way to go for the audience to understand what exactly it is that they are getting. And all things being equal, they would choose sustainable investment, except for the priority is still the return on investment. And there is still a certain, I would say, doubt that this is going to cost them return. So we need to position this and clarify what the value is. And at the same time, I would say investors, and we are all investors, abhor rigidity. We like the flexibility. It is, of course, necessary to have a framework to make sure that there is oversight, that there is implementation and enforcement, and that there is a possibility for redress, which is not the case as yet. So flexibility for us, not a problem, as long as there is transparency and we understand what is happening. Now, what we also would like to say is that defunding companies that are not there yet, we are not necessarily a fan of that. We know they are part of the problem, but we also understand that they are part of the solution. And their input is needed to fund the transition. And if we cannot invest in these companies, then who is going to pay for the transition? So we believe that even if, and that is maybe why the Belgian ESG label for funds is called Towards Sustainability, because we do not believe we are there yet. But if we're going to be too rigid and say you cannot invest in companies that are not there yet, then how are we going to get there? So that is, I would say, our thing. We are a fan, in theory, of green bonds, but I don't think they are sold a lot in Belgium, A, because they're not available too much, and B, because people are looking at them thinking, well, what exactly am I buying here?
And how do you think this could improve, especially this communication towards investors?
Well, the roadmap suggests that there is the concept of additionality. We like that a lot. The fact that we can go a two-step approach, A, fighting the negatives, and B, improving the positives, and that each little step helps us towards the goal. And I think that is for investors that manage their portfolios. It's the essence of everything that we are doing. Additionality, we try to minimize the negative and optimize the positive, and we expect the industry and the regulators and the exchanges to do exactly that. We do not expect a gigantic leap overnight. We do not think that in November we're going to have the Bible of sustainable investing, and hence we say we rather have a smaller Bible, but one that we can manage and build from there, than to have something imposed that kills the industry, that also kills the appetite of the investor for these type of products. And that's not going to work, because we also see that once regulation is in place, it never disappears again. So we caution against too much.
I think maybe if I can add something on the green bond and the need for investors for transparency. I think this is really a progress brought by the sustainable finance trend, which means, well, for a bond, a plain vanilla bond, you do not know in what type of projects you invest. Now with green finance, this is transparent, and the post-issuance report, the allocation report is requested. So the issuer has to deliver on its commitment and show it to the investors. And when we speak about greenwashing, especially in green bond, I'm always very skeptical about at least that type of instrument, for the only reason that it's not at all in the interest of the issuer to lose its credibility. Because, you know, then greenwashing should be assimilated to fraud. So this is clearly not the type of instrument which should be used for greenwashing. On the contrary, it's a fully transparent instrument on which the issuer has to deliver on its commitment and show how potentially, the allocation should be demonstrated now, because the funds that have been raised through the bonds should be allocated to the project, and this should be demonstrated. The measurement of the allocation is something which is being built, but this is requested indeed by the standard. So I think we are clearly moving towards full transparency for investors with that type of instrument.
We can only confirm the interest there. We do notice that a lot of the bonds are green, as in environmental. I think there's a lot of interest from our side as well to see governance and social, but how to measure the impact, how to know what exactly you're doing there.
Coming.
If there is a bond, I would avoid in the beginning to implement also the social and the governance one. I would look at the green, which is already complex enough. That's a little bit my, because the whole story on the greenwashing that I read from time to time and hear, when you go a little bit more in depth, sometimes the people have not understood what the people are telling in their information. So because it's a very complex matter. I can give you 100 examples. I'm an engineer, so I can give you 100 examples where you will not get a way out of a problem that I put on the table. So it's not an easy, it's not something like a finance difference in intangible interpretation in the United States versus Europe. That's very easy to explain and very easy to understand and live with. But in the environmental issues, that's a very difficult one. We will come back to the social one probably a little bit later.
Yeah, you anticipated because we actually receive a question on the social aspects, but let's keep it for the end because before we have our final session, which is on the global dimension that we already touched upon it before. And I would like to start with Saskia because Europe so far has a leading role in the sustainable finance agenda. But solution, of course, needs to be global because the fight against climate change is a global effort. How is EFRA coordinating with the international standard setter? For instance, the International Sustainability Standard Boards that Luke already mentioned earlier.
Yes, thank you, Sarah. And yes, indeed, this is a well-known question to us. It's almost the first question that usually comes on the table. I think I should start with saying it's really about cooperation. This is not about competition. We're all working towards the same common goal of getting the climate change and so on. And we are all convinced that reporting is a tool that helps for that. So we're all working together. So it's about cooperation. We are not in competition. How have we done it? How are we doing it? Actually, throughout the project, international standards have been very important. Well, you know as well that the project task force had to start before the ISSB even existed, and even there were no discussions at the time that would be created, so we had to start a lot before. In this report that I referred to earlier of 8th of March of this project task force, there was a sort of new word called co-construction. So that meant sort of building on these international standards and contributing to. So the idea is as well that Europe will influence whatever is developed on the international level and can bring our experience. And then if you look in the proposal for CSRD, and I think Commissioner McGuinness actually explicitly mentioned it, that it had to build or take into account, there are different words in the CSRD, in the proposal for the CSRD. They talk about a constructive two-way cooperation with leading international initiatives, aligning with those initiatives, but taking into account the European specificities. And also explicitly in the article, but this is all in the preambles, and the articles in the end are the important ones. It's said, where I referred earlier to, that after 3 years there should be a review, and in that review it should be considered whether the international standards have been taken into account. So in developing these standards, we have clearly started from what was there. So there were different things in different areas. If you speak about environmental climate, of course we have the TCFD. The S2 of the ISSB, the exposure draft, is also based on the TCFD. But in other areas, there is less international standards, but also those have been taken into account. So like of course, GRI, SASB, and other standards. We worked very closely with the Technical Readiness Working Group of the IFRS Foundation, which later then became the ISSB. We also have to look, as EFRAC, we had also in the proposal for CSRD to look at all the European legislation, because it should also be in line with the European legislation. So you already referred, I think, a couple of times to the taxonomy, but also the SFDR. So that is another element, so you have to bring everything together. In the public consultation which we published, there is a sort of cover note, and in that cover note there are a couple of annexes, and they compare actually what EFRAG has done and what the ISSB has done, so you can see the differences. But you mentioned already before, I think, or Luc mentioned it, we are at a different pace in Europe, so that is, we are not moving at the same speed. So we had to start before there was something of the ISSB, and we have to deliver in November before the ISSB is ready with their standards. Of course, we are working very closely together. The IFRS Foundation has created this International Sustainability Standards Board Jurisdictional Working Group. I have to read it out. They had their first meeting on the 16th of May, and both the Commission and EFRAG are involved. And they published actually their notes, and it's actually interesting what they said there. They said the SEC, because it's several jurisdictions, EFRAG and the ISSB representatives all acknowledge that there is a significant compatibility between these proposals. So I think the willingness is there from all sides. So EFRAG will also, or has proposed to create a working group with the ISSB and the Commission to work very closely on this possible convergence, and where possible, because we should not have differences for having differences. If there have to be differences, they may come from European legislation or otherwise, there must be clear reasons for it. And you may have seen as well yesterday, the IFRS Foundation issued a call for a sustainability standards advisory forum, and there they said there would be 3 members from Europe, including non-EU. So also there we will have, it's like the similar, well, for those familiar, the similar thing as ASAF on the financial reporting side. So I think there's really a willingness to cooperate and to move all together ahead. But we have to realize that it's different speed, but it's also different topics in the sense of the ISSB has now published general principles and the climate change one. We had to do in the line of the proposal for CSRD the whole scope, so environmental, social, governance. Ben was referring to that he was interested to get information on all. Well, they will be obliged to disclose information on all. So it's a much wider thing, and I guess it's to be seen in the future how this all will be arranged, because the ISSB still has to do their agenda consultation to decide what they will be going to work on as the next standard. So we don't know if that's the S or the G, or perhaps biodiversity or whatever.
Yeah. No, that's quite interesting to see that there is willingness at European and global level. But look, is it reasonable to ask companies recovering from the COVID-19 fallout and now having to face the impact of the war in Ukraine to apply all these new standards and all these new rules? For instance, the Commission just published the Sustainable Corporate Due Diligence proposal. Do we risk losing competitiveness at European level?
I think what has happened with the COVID story and Ukraine is a level on top, has complicated extremely life of the people. Today, let's look at the simple consumer. The end of the month is more important than the end of the planet. And for many companies are of a smaller size, I'm not talking about real big ones, the end of the year survive over there in their relations with the financing or community, whatever it may be, is more important at the end of the planet. So the cost of what we are building today, how good our intentions are, is extremely important. And what is worrying to us is that we see too many legal actions taken over the last couple of months or years that are not really always good in connection with the real problems of the environment, the issues of the environment, or that are timely not coherent. They are some things that is not reasonable, or they are simply not well coordinated with existing legislation. So for us, this is a cost threat that is something that we do not understand, because the legislation should be an addition on what exists today and build a comprehensive strategy and a very well-built, coherent framework. Then we will be moving in a good direction. But we see too much, how must I say, jump-ups of legislation today that are not really what we want. The European Commission, as such, the whole program is not contested by us as companies as a whole. It's not at all about that. We really think that the Green Deal has a lot of opportunities for companies to position them much better in the world of tomorrow, because we will be potentially the first ones to give answers to very complicated problems. So this is not the issue. The fact is that we should have things that are really building our positions on a way that is really the companies can realize. If you look at the due diligence proposal, we think that there are a lot of things that are creating excessive costs for companies, and therefore are not at all effective for the positioning in competitiveness versus the rest of the world. So they are even a danger of loss of competitiveness for us. So in this sense, I can give you an example on the CSDD obligation for the exempt and the obligation of comments on the exempts issue. When you look at how companies will have to perform this obligation that is in the CSDD embedded for the moment, then we think that the companies are not capable to answering all those questions in relation worldwide obligations that are existing today in relation to their suppliers and their contractors for due diligence approaches. They will not be capable of answering it country by country, project by project, or action by action, whatever it, activity by activity. So for us, if we don't come back to the same system as we mentioned in the beginning, namely focus on what is the really most important risk-adverse elements that has to be reported, and give there a good report, and not a costly one, but a good, effective one, then the companies will be really in trouble with their system. And certainly today, I can assure you, I am still on the board or in contact with many smaller companies that are just in the framework of the reporting obligation, not being SMEs outside, but already in today. And they have stopped since 3 or 4 months to think about ESG. They have no time. They are trying to survive. I think the COVID being finished, we thought, rightly so, we have overcome issues, the most important ones. We underestimated a little bit the blockage on delivery, because that was continuing afterwards. But then came the Ukraine story with all the inflation of cost for companies, both in salaries as in raw materials, in energy and God knows what. And this is really creating, I'm afraid for what we will see as in the outcome of the results of this year, 2022. I'm afraid about that. So we should be very careful how we implement or what kind of legislative actions we undertake. And we have to make the analysis. You talked about the cost effectiveness analysis, but it will be very important to see and to handle accordingly when we have the result of that one.
Thank you, Luc. I have a final question for all of you, which actually builds on what Luc just said. So that Europe until now was leading the way in sustainable finance. We already said it early. But do the present circumstances, so the cost of the war in Ukraine, the energy crisis, and so on, do they risk undermining the progress made so far, or will it act as an accelerator to move forward even faster?
If I may, we expect actually both at the same time.
Okay.
To be clear, short-term thinking, and let's make sure that we understand that investors like that the companies are focusing on their raison d'être, which is to create value for themselves and the investors. So that remains, I think, the priority. But at the same time, we see that some political leaders are willing to throw out ESG for practical real-life reasons, and there should be some middle ground. What I want to say by that is that you remember that story, they say culture is just a very thin layer of veneer on top of the Barbary. Well, the Barbary is here, and apparently culture and ESG are the same thing because they go out the window. We do not understand how you can make a contract to import for the next 15 years oil and gas from fracking. That is something that goes beyond our logic for sustainability. And it is true that maybe Europe was leading in the beginning, but through economic missions, we find that areas like the Arab countries and even China, they have the power and the money apparently to make quick strides, and they are quickly gaining, maybe even surpassing us. But I think we still, on a conceptual level as Europe, show the way, because without the pressure from Europe, I don't think the rest of the world may be as interested. So that's the good thing. Long term, I think it's increasingly clear that the sustainable approach is the only way to go, despite the inevitable growing pains. And we were very happy to see the European report issued, I believe, 2 weeks ago, where it said it is important that as larger percentage of the population is included in this transition, and by included we mean invested, of course. So we're a bit unhappy at the same time but this is a national level in Belgium. We see some political parties making propositions that are diagonal to this goal, I would say. That makes us quite unhappy. We believe that we can be partners and by investing solve a lot of the issues that plague our European society, be it the widening wealth gap, be it the problems in communicating between unions and governments and workers and people who save and invest. By investing, we all become entangled in the same common goal. So I think the financial education for more people to understand what is at stake, how it works, what inflation is, what sustainability is, what investing is, I think would help us all.
Yeah.
So never waste a good crisis, I think.
Julie.
Without pressure, we will not do it. And without Europe, the world will change slower than in that respect. And
it's exactly that. Short term, this war and this inflation is hurting us, but it's making ever more clear the inevitability of sustainability.
I agree that it's both at the same time, but we should definitely keep the focus on accelerating sustainable finance, as you just mentioned, Luc, as well. Yeah. Post-COVID, I think we addressed indirectly and by coincidence, but luckily, the change of behavior and the change of mindset. And so also for investors beyond data, it's really about changing mindset and understanding the impact of its behavior. And I think that the war, again, maybe even more than for climate change, make people realizing what's at stake, and that I think that people are even more keen on less eating, less driving, because they know that there's an energy crisis for the time being and they have to pay attention. At the same time, we have to observe, unfortunately, that in financial markets, it has been a very complicated year, of course, so far. And I think that the era of cheap money is coming to an end, unfortunately. And we also saw that global sustainable debt issuances in terms of amounts being issued is really down on a year-to-year basis by almost 20% already, with green bonds down by 8%. Yeah. So which is really concerning at the same time.
Yeah. Luc, Saskia, anything to add?
Well, I think most of the things have been said. I agree with your short-term and long-term perspective. I think longer-term, we have to do something on sustainability, and reporting transparency is a tool that we need to make it all visible. So that will have to happen. I think just what happens around, of course, the war in Ukraine is terrible, and we have to face that. But we have also all the climate things that happened to us. We had all the inundations in Belgium. Then you have this terrible thing in Germany and so on. So it comes closer and closer. So I think people do realize and they want to do something about. Of course, what is the most urgent, they want first to fix that and then to move on other things. But I think sustainability remains on the agenda. It will not move. It will remain a priority. Perhaps not the first priority during some periods, but it will remain priority. And reporting is a tool to make that all visible.
But I think the companies are absolutely convinced that they have to do it, also in terms of surviving for tomorrow. So the image, the move is there, so we should not destroy the move, certainly not. We should keep it ongoing. Simply we have to, for me, the accompaniment should be such that the companies are able to do it, which means probably you have to accept that it will be spread into time, and that will be gradually in a gradual movement. And if you do that, and companies can be helped sometimes by European programs, for example, in research or God knows what, or other things. In Belgium, for example, we have the capability of sending people to the werkloosheid, unemployment, thank you, on cost of the government, which has saved a lot of companies in the COVID period. Maybe they should consider to prolong that for the Belgian ones. I don't know what they do in France or the other ones, but every government will have to look at how to make this thing continuously moving in the right direction without killing the companies, and that's all. That's my conviction.
I'll reiterate what I said earlier. There was a project in Belgium a couple of years ago, Heerlijk Helder, which means wonderfully clear language. As long as we understand each other, I believe we will find a solution. But as you said, the alphabet soup that we are creating right now doesn't help the companies, doesn't help the legislator, doesn't help the consumer. If we can reduce to something that we can understand and communicate on the same basis, then I think we will have an easier way forward.
No, that's very good. And it's very good to conclude this panel on a positive note that sustainability is not something that we can remove from the political agenda, is there to stay. We have just a couple of minutes, but as I mentioned, we received quite a few questions, but I will focus on the one on the social aspect because it was mentioned earlier. So do you think that we can include in and start talking more about the social elements when talking about sustainability, or is still too early because it's difficult to quantify? It's more complicated than the E part of ESG.
We would love to talk about it, but we do understand the difficulty in measuring, setting an objective, but at least bringing it to the table, having a conversation is the start. We do not expect to have a framework in place by the end of the year, but it should be something that is discussed.
Yeah.
Well, EFRAC has 4 exposure drafts in the area of social, so I think everybody has the opportunity to say what they think about it, and should say that, because I think this is one of the areas, of course, is at least at international level, less developed than if you speak climate. So I think it's really important to get your input, and it includes metrics, some of the metrics. So it will be interesting to hear both sides, what you think as a preparer and what you think as an issuer, and then stock exchanges in between.
Well, I have, maybe, sorry, a different position on social, especially on social bonds. I'm quite optimistic and positive. We had huge level of social bond issuances last year, especially post-pandemic. So COVID recovery, but and this is something which is measurable, but depending on the type of use of proceeds. It's indeed not in terms of CO2, which is easier, of course, for environmental objectives, but for social, it could be in terms of number of vaccination, of numbers of jobs granted, of hospital builded, of green building, of gender balance boards, for instance. So there are plenty of different types of use of proceeds that are considered as social, and that could, and for which at least the use of proceeds could be so are traced, and so the allocation is also something on which the issuer has to report, and the impact can be measured. Of course, I agree with you that there might not be always common and harmonized metrics that we are anyway lacking as well in the environmental objectives, I think. So I think we need to start somewhere. And as long as you mentioned earlier, on transparency is granted for investors, and that what was promised initially when the bond was launched and what is at the end demonstrated is the most important. And that's where indeed exchanges have a role to play to ensure this transparency and give all the information needed to investors.
Thank you.
If you have to collect your data from the European environment, I think your answer is correct. But if you have to do it from the outside world,
emerging markets are something we are working on.
In this world, and you have 1,000 suppliers, and the products are coming through Romania from China, and from China comes from another place, and you have to look at the social aspect. Not easy to find the answer.
Hence the additionality starts somewhere.
Yeah.
Because the job at hand may be so large. If you're, I would say, daunted by the massive job and you don't start at all, we're worse off.
Sure. No, but I'm not saying that we shouldn't start. That's not what I'm saying. But I say to have a reliable reporting system that is supported by data that are trustworthy, That's not an easy one.
And in the meantime, make return.
I'm afraid I need
Small
to.
detail.
I need to close now the conversation. We could continue much longer for this very interesting topic. So thank you very much to the speakers and to the audience for participating in this panel. We will now have a very short break, just a couple of seconds, and afterwards Riess will take you to the next part of the afternoon section. Thank you and goodbye.
Hello again and welcome back. And it's a pleasure now to have alongside me Jean-Paul Servais, the chair of the Belgian Financial Services and Market Authority. And I think, Jean-Paul, you're going to talk about a topic very dear to my heart personally, financial education. So the floor is yours.
So good afternoon, good morning, good afternoon, or even good evening for people having the possibility to have the discussion with us from Asia. Because I think that is important even. And thank you for having proposed me to give a keynote speech. Really, it's an important meeting, well-known, FESE, and congratulations for the quality of your program and the success, because I see that many people are in the audience, at least in the virtual audience. So that's the new world. Speaker on the stage in a studio, and you, I would say, somewhere in Europe. Allow me, first of all, if I may, René, to stress that I am very pleased to have the opportunity to speak about a very interesting, hot topic. Let us be clear. I really think and believe that I would say the message that I would like to give is very important because it's linked with John and Mary in the street. It's about how to promote the CMO in Europe, and also with a very important link with retail participation, which is, I think, something new for the European Commission, to be able to stress the fact that there is no possibility to book progress when we speak about CMU without involvement of retail investors, especially in a world post-COVID, when we speak about how to have a more finance-based market and how to be involved in the finance of the real economy. And that's something I can tell you when I see the sociology, the landscape of investor at the Stock Exchange of Brussels, because we are here in the premises of Euronext Brussels. That's a very important message. As you know, René, ladies and gentlemen, the CMU was launched 7 years ago, in 2015. Frankly speaking, I think that it's rather objective to say that if progress has been made, of course, even if it was not by definition so easy to manage, but if progress has been made, I think that we need to acknowledge that EU capital market remain to some extent fragmented. And this is why the Commission adopted 2 years ago, in 2020, a new CMU action plan, which pursue 3 main objectives, as you know, René. First, supporting a green, digital, inclusive, and resilient economic recovery by making financing more accessible to European companies. Second well-known objective, making the EU an even safer place for individuals to save and invest long-term. Because let us be clear, we are speaking about trust. If there is no trust about the quality of the product, if there is no trust about the quality of financial information, ESG information released, for instance, by listed company, the trust will disappear. And without trust, there is no capacity to have a more finance-based economy in Europe, even if I think that we are on track and that we are going in the right direction. And last but not least, how to integrate national capital market in a real, genuine single market. And to be successful, and that's my personal point of view, I believe that the CMU needs to be strengthened by 2 pillars. First pillar, financial education. Second pillar, strengthening the CMU, also implies developing and implementing a clear strategy in the field of retail investor. When I had the pleasure to launch, I think, the successful story of the FSMA, Belgium Financial Supervisor, working in a twin peak models with the Central Bank of Belgium, I was used to saying every day to my staff, two parts of a DNA. How to promote, I would say, the involvement of retail investors. How to ensure that the financial sector deserves the trust and the confidence from John and Mary in the street when he has the possibility to have a dialogue with a banker, when he has the possibility to benefit from an investment, and how to invest in a financial product which I would say match his profile and investment objective and financial capacity. And second pillar, it's about financial education. And that's the reason why, yes, I dare say the first pillar, it's about financial education, which is something, let us be clear, everybody, of course, it's like, I would say, green finance is support of financial education. But I am not sure that everybody agrees that it has to be, I would say, the first priority. But that's what we think in Belgium with my staff. And the CMU should encourage the safe participation of informed, financially literate retail investors. And that's the case. I was very impressed by the content of many speeches given by Commissioner McGuinness, I would say the last month, saying financial education, it's a top priority. Of course, many people would say from the European Commission, it's quite obvious. Not at all, because we know that subsidiary principle in the EU means that most of the time financial education as such, it's not part of the mission statement for the three co-legislators. Most of the time, take into account the national specificities of the 27 EU member states, it's something for which there is not as such a lot of room for maneuver for the European Commission. But anyway, Commissioner McGuinness decided to stress that it's a priority, and I'm very happy to see that, and I hope that she will be able to visit our new financial education, which is not far from the Berlaymont building, only 200 meters far. And from this point of view, I think that the CMU should encourage the safe participation of informed, financially literate retail investors. Let us be clear, at the moment, and for the obvious reason I just explained some seconds ago, we have to confess and admit that financial education is still underdeveloped in Europe. Maybe for two reasons. First of all, because I think that we need to change the approach. First of all, because retail investors need to be empowered to benefit from digitalization and sustainable innovation. Recent events and evolution, for instance, increased retail investment. That was a surprise for many people, that young people were back on the stock exchange. That's what I saw in Belgium. Okay, of course, maybe people had to stay at home, but the fact that people prefer to invest in a regulated market than losing their money in Bitcoin, that's something I support. Let us be clear. And from this point of view, recent events like the increased retail participation in market during the COVID crisis, the GameStop case, lessons to be learned, the hype about, I would say, around cryptocurrency, all these aspects emphasize the relevance of some key principles of financial education, such are, of course, diversification, key aspect. And enhanced financial literacy could also contribute to correct the possible investment biases in favor of saving accounts at the expense of more long-term investment. Secondly, I think that financial education has to be promoted by definition at EU level, because it's a complementary tool to regulation and supervision to enhance investor awareness, critical sense, and rational behavior. But at the same time, let us be clear, in order to avoid any kind of misunderstanding, at the same time, financial education should not be used to shift responsibility solely onto the consumer for making sound decisions. Financial literacy must go hand in hand with good consumer protection measures, fair advice, supervision, enforcement of rules. And by ensuring that investors are financially literate, well protected and treated fairly, MiFID philosophy in fact, we can build up their trust in the markets and help them meet their long-term financial needs. In other words, it means that as supervisor, we need to have a balanced approach, I would say. We have to avoid to say only lessons to be learned from the banker, from the crisis, or only promote financial education. We in Belgium, especially at the level of FSMA, we promote a balanced approach. We are doer, we took a lot of initiatives about financial education, but I think that we don't hesitate to be supervisor in our market. So it's a kind of, I would say, that would be a mistake from a particular point of view, either to say only rules for the banker or promoting financial education. So in other words, how to achieve this goal, you may ask. First of all, at European level, because it's a European meeting, concrete coordination initiative by the ESA, and namely FSMA, I think, could be a first step towards strengthening investor education at a pan-European level. And therefore, Renner have a good news, which is a bit underestimated. And as a second step, and as proposed by EIOPA in its technical advice to the Commission on certain retail investor protection aspects, EU directive could be modified horizontally in order to follow the model of the mortgage credit directive. Not maybe the most well-known directive. But in this directive, there is a very important provision saying that the objective of this directive is to enshrine the task of consumer education in the mission statement of the NCA and the ESA. So you know the power of the precedent when we speak about EU law and EU constitution. And there is a precedent. So I am very happy to see in this technical advice of EIOPA, which is not maybe the most well-known technical advice of EIOPA, to say we need to copy and paste what already exists in the framework of the European Mortgage Credit Directive and to enshrine the task of consumer. We all know what it means. It's not a precedent, but it's always a precedent, what is put somewhere in a statement at EU level. And both action, coordination initiative, and to see to which extent we are able to copy and paste, extrapolate the precedent of the European Mortgage Credit Directive, both actions could lead to the development of best practices in order to increase the financial awareness, I would say, of literacy of a consumer to the benefit of EU citizens and more broadly of the internal market and the same. So what does it mean? EU, it's not only top-down, it's also bottom-up. And if I may just say a few words about the Belgium experience. When we start, I would say, the FSMA 11 years ago, in 2011, we received for the first time a legal mandate to contribute to financial education. That was not the case before. So first, lobby in order to have this case. And this is not the case, let us be clear, for a majority of NCA in Europe and outside Europe. 2 years later, we launched the well-known Wikifin program, which had the copyright. Well, no problem. And we decided to launch that because we think that we need a kind of branding. FSMA is more or less well-known. Wikifin is more easy to understand and to recall, and that's the name of our financial education program. And it's a very comprehensive program based on 3 foundations. First one is to speak to everybody not far from here. We are used to go to the central station in a mall, in shopping center, in the street for the national feast in Belgium, the 21st of July, to speak about financial education, not only in our premises. And it's important to do that. Of course, the most visible, I would say, part of this first pillar is our Wikifin website, which offers free and reliable information about money matters, not about sophisticated financial instruments, but I would say the day-to-day experience related to financial basic, how to manage your budget, how to avoid financial projects. And there are a lot of handy tools available on website to the public, such, for instance, heritage simulator of saving accounts comparative to. Second pillar, that's a collaboration, a partnership between the FSMA and our ambassador. And when we speak about ambassador, about financial education, I mean by that the teacher, especially the teacher having a dialogue with teenagers. And on the Wikifin side, we created a dedicated platform. And last but not least, I would say, our Wikifin lab, not far from here. I think that I may say that you visited the Wikifin lab. Thanks for that, for your visit. I appreciate that very much. 200 meters far from here. That's the first fully fledged, free financial education center, and that we launched 2 years ago. And the Wikifin Lab is an interactive and digital center for financial education. Is it successful? Let us be clear. When I launched a Wikifin Lab, I only received, I would say, very, very mitigated advice about possible success of experience. 2 years after, it's fully booked until the end of this year, civil year. Okay? Our website is visited 4 million times a year. Of course, we are not the Red Devils, the well-known football team from Belgium. We are only, I would say, administrative supervisor. But again, it's a real success. And therefore, what is in return? To be a doer, to be committed, and to take initiative. That's for the first pillar. Second pillar, I will be shorter for the second part of my speech. It's how to strengthen the fact that CMU implies developing and implementing a clear strategy in the field of retail investment. Again, new accent, and thanks to the European Commission for that, because we know that the European Commission is currently considering different initiatives to identify and tackle weak points. That's the job, I would say, of the European Commission, weak points in the retail investor journey, taking a holistic view and putting the perspective of the retail investor at the center. And it aims at developing a retail investor strategy, which is expected by the end of the year. And of course, if I may, even I'm not the spokesman of the Belgian government, but I think that I may say that the future Belgian presidency in 2024, first part, is ready and fully committed to bring in 2024, before the election, to fruition this project. What does it mean, in other words? 3 things. First thing, and among the different topics addressed by the strategy, adapting the regulatory framework to the digital world. If we have the pleasure to live with a mobile in a private life, it must be the same when we are, not me, because I am a supervisor, when we are investor. We need also to adapt our framework to what it means a digital world for John and Mary in the street in their capacity of retail investor. And it means that the development of new technology and means of trading that provide easy access to capital market should not be hindered. We must keep up with the time. Let us be clear. And it also a challenge for many stock exchange. Rules should be adapted to innovation, be paperless, and what I am used to saying, smartphone fit. Technology should be increasingly relied on as a means to facilitate the provision of information to clients in a more meaningful way, using techniques such as layering. Of course, we know that when you have to read something on a small screen, the quality information, and I would say the channel is quite different. And for instance, we need to have 3 kind of layers. The first, I would say, layer, it's about the most vital information. I would say it means information investor must know. Second one, and I would say in a virtually engaging way, including information that investors should know. And layer 3, nice to know. Simplification effort is very important. And also the new strategy at the level should consider and address emerging risks relating to new trends and forms of trade. What could be my conclusion, I would say? Digitalization is an added value in order to increase access to capital market. Trading apps, of course, are mainly used by new type of investor. We have to work, I would say. And this new type of investor tend to be younger and take more risk. Is it something which is by definition bad? Not at all, if it means also diversification and how to be involved in the financing of really copy trading. There are a lot of aspects. And not to mention, of course, the hype around cryptos. And in this remark, I would very welcome a lot of initiative, not only at European level. In Spain, they took initiative. My colleague Rodrigo took a very interesting initiative as chair of the Spanish supervisor, the CNMV, to control crypto cassette advertising. We need to learn from each other. That's what we will do. We will copy and paste the Spanish example in Belgium, because all these trends deserve proper attention and appropriate regulatory savory. And I will conclude, dear Irene, by quoting one of my favorite heroes, Sir Winston Churchill. You know the adventures with Winston Churchill, there are a lot of many interesting quotes. We are not sure that he was able to invent all of them, but one of the most famous quotes of Churchill is say, to improve is to change, to be perfect is to change often. The world is changing, and it means that development are happening fast. And this is time to get on board and acknowledge that change is necessary. We must take full advantage of the benefit of innovation and digitalization. And to that end, and that will be my last comment, technology, I would say, and regulation also should be future-proof and not hinder the development of technology, which is access to capital market. This goes, however, hand in hand with appropriate investor protection measure and can only be effective by enhancing financial literacy in Europe. So it's a comprehensive mission statement, and this is absolutely important if we want to have, I would say, an efficient tool to build up trust and confidence in financial market. That's my message.
Thank you very much, Jean-Paul. And I think compliments. I've seen the Wikifin Lab, and I think what inspires me, I think also is your passion to talk about this topic. I think it is really underestimated, as is probably the retail agenda. I think we're looking forward very much to the retail investor strategy from the Commission. I think it's very important. We'll discuss it in the next panel. This next panel will be on Capital Market Union. It will be moderated by our friend David Wright, chair of EURFI, and sponsored by Börse Stuttgart. And just to say briefly something about the sponsor, Börse Stuttgart is the 6th largest exchange group in Europe with strategic pillars in the capital market business as well as in the digital and crypto assets. And they have a strong focus on retail investors and pride themselves that they're also offering a wide range of financial instruments from equities, ETFs, securitized derivatives, corporate bonds, to even various crypto assets such as Bitcoin and Ethereum in a regulated environment. So we'll be right back for that panel, and we take a very short break to reconfigure here in the studio. Good afternoon, everybody, and welcome to this distinguished panel. My name is David Wright. I'm the current chairman of EURFI in Paris. I'm very honored to chair this discussion on Capital Markets Union. I'd like to thank Peter and Rainer for their kind invitation. We have 4 very distinguished panelists. On my far right, Anthony Attia, Vice President, Head of Primary Markets, Euronext. Welcome. To his right, Ondřej Kovařík, who is a member of the European Parliament Econ Committee from the Czech Republic. To my left, Tatiana Panova, in the hot seat on Capital Markets Union in the European Commission, DG FSMA. And to her left, Guillaume Prache, the Managing Director of Better Finance. May I say the doyen of protecting consumers and retail and investors. Welcome, Guillaume. Well, with all the political tensions we have, with all the demands for environmental transition, digital expansion, post-COVID economic recovery, it seems to me anyway, Capital Markets Union has never been so important. Capital markets are going to have to finance these big political projects. So how are we getting on? Are we on a fast track delivery, or is it slow track? What measures are coming for us in the near future? So let's begin by looking at the state of play and also looking a little bit politically about the strategic autonomy debate, about Europe's own capacity. Tatiana, tell us, are you in an optimistic frame of mind?
I'm always optimistic. I think one has to be. Well, you asked David where we stand. So if we look at the action plan that the Commission adopted a few years back, and if you recall, we've announced 16 actions. By now, we're largely done with 10. And I think by the end of the year, we will be done with 13 out of 16. So I think this is a good sign. Now, of course, we are only talking of the Commission's plan, right? What is probably even more important is where do we ultimately get? And for that, we do need both the member states and the parliament support, because ultimately it's the co-legislators who make law in the EU, and it's probably, it goes at the speed of the trilogues, if I may put it this way. So with a lot of things, we are quite happy. I think there was a good package tabled last autumn with the 4 CMU legislative proposals. Later this year, we will be tabling 2 more. One dealing with public markets, so trying to alleviate listings, in particular for SMEs, but not only. So the so-called Listing Act. The other one, a very complicated proposal because it goes into a very complicated area of insolvency law. So a proposal that would seek to harmonize targeted areas of corporate non-bank insolvency. So I think overall, I think we're doing fine. Whether we're doing great, I think the future will tell us.
But we're running out of time, aren't we? I mean, effectively, Q1 2024 is deadline day, isn't it? Because the European Parliament will be breaking, Ondřej. How do you see things from the parliamentary perspective? Do you see there's a dynamic here? Do you see real movement? Do you see people believing in Capital Markets Union?
I definitely see a different dynamic from what we witnessed a couple of years ago. And I think I remember at the beginning of this mandate of this parliament, we had a lot of discussions on how actually to overcome, let's say, very slow and not very convincing results from the, let's say, the first generation of CMU initiatives. And I think also thanks to the work of the Commission, the high-level panel, the action plan, number of proposals that were put forward, I think we are actually speeding up the dynamics. And you're completely right. We actually have the clock ticking now, and we have to deliver, because the ultimate thing with the Capital Markets Union is that you don't see immediate effects as of day one. This is a long-term project. And in order to be able to deliver, there has to be long-term commitment, and also there has to be a political will in order to deliver. And I think we are on a good track. We have to finalize the discussions on the proposals that are currently on the table. We heard that there will be some new proposals on top of that, and I think that is a good news. But I would say the bottom line here is we need to actually speed up the project of Capital Markets Union, and we need to make it work, because we definitely need it. We will, especially in this context when we have post-COVID recovery, but at the same time war or post-war economic consequences, we need to have very strong Capital Markets Union in Europe.
Just one question to you, which Tatiana did not mention, securitization. You know, if you ask the European banks, especially the big banks in Europe, what would be a good measure to improve their competitiveness and indeed create a great deal of securities which could underline a capital market, do you think the Parliament's ready to support a sensible set of proposals on securitization?
That is a hard question. I cannot speak on behalf of colleagues. On my behalf, I think we are ready to have this discussion and to support that. But I think also from the discussions that we're having on some of the files that we are currently negotiating, I can see some decent level of acceptance, if I can put it this way, from all the political groups. Obviously, some of them are very much concerned about what kind of securities we're talking about, what effects it will have. Does it fit, for instance, into the sustainable finance framework, et cetera, et cetera. So I think the discussion is there, but it's really about finding the exact angles and the defined parameters of this debate.
Good, thank you. Anthony, give us the perspective from your exchange. Do you see things happening that you like? Do you see things happening that you don't like? Where are we going?
Thank you, David. Look, at Euronext, we cover 7 exchanges and of all sizes, and we also work with almost 2,000 issuers, a lot of SMEs, more than 1,200 tech companies, more traditional companies. They are in constant research of the right investors. They want to attract retail flow, so the willingness is there. It's not going fast enough. I think we all agreed on that for sure. I must admit that we were a bit disappointed by the conclusion of the CMU action plan from 2020. But listening to Commissioner McGuinness in a speech earlier today, I felt good about what she said. In particular, about freeing the movement of capital, and I want to pick some of the elements that she mentioned. The review of Solvency II for the insurance, because today a lot of insurance companies would like to invest on the equity market, and because of risk constraint liquidity models, they end up investing either on large caps, where we don't need more liquidity, it's there, or on non-listed companies, because it's easier for them, believe it or not, than on listed SMEs. So we hope that this is going to be fixed. The SME IPO EU fund is a great news for sure. The MiFIR review is important, and obviously the Listing Act, and I guess we're going to talk about that, and the access for the retail. And retail is looking for a transparent price formation. They're looking to access all of the equity market in Europe, not just in their own country, and this is still difficult today. So I believe the efficient price formation should be made out of transparency, and hopefully this is going to be improved. And also I mean, it's not a secret, but the payment for order flow. If we talk about not avoiding the mistakes from the US, the payment for order flow is definitely a mistake that we should avoid coming from the US.
Guillaume, how do you see things so far? Are you, of course, there's a big retail package coming up later from the Commission, I think probably by the sound of it early next year now. But do you see things happening? Are you confident that we're going to bring in a new retail dynamic to the capital markets in Europe, or is the jury out?
Thank you, David. I concur with all people here that speed is really a priority. Today, Eurostat announced the annual inflation in the Eurozone reaching end of May 8.1%. Today, the German sovereign bond 10-year interest rate is 1.05%. And this is what economists call financial repression. And this is financial repression at a record level because the majority of European citizens' savings, financial savings, are in fixed income related package products. And so I let you compute the real loss that they are suffering. We anticipate hundreds of billions of euros of real losses, of loss of purchasing power for European retail investors this year alone. Already last year, inflation was rising and also interest rates were at the bottom level. So it is really should be a wake-up call for implementing CMU and especially the retail investment package ASAP. That's why I am worried to hear that the retail investment strategy is going to be switching to 2023. It had already been delayed a bit from the 2020 CMU action plan, which had targeted for first half. I must say I sympathize with the Commission's struggle because I can see even on, for me, no-brainer issues like payment for order flow, which should be called payment for retail order flow, because no one is wanting to pay for professional order flow, of course, is facing a lot of opposition from certain member states, and that was, of course, a proposal we supported very much from the Commission. So we have always supported very strongly the objectives of the CMU. since even the first version of 2015, so it's 7 years ago. And I'd like to remind you about these objectives, which are set up in the retail investor strategy, which we fully endorse, but as I gave you the figures, we are not at all yet there, is to ensure improved market outcomes. This year doesn't look like it, as I just said, to empower retail investors. There are still, as I said, a majority stuck to these retail package fixed income related products, and to enhance their participation in the capital markets.
Yeah.
I'll come back later. I'll give you example that this is unfortunately not yet happening. So maybe I will have the opportunity later to come back to that.
We'll come back to that, Guillaume, because I'm going to put you in the hot seat as I'm going to let you be the commissioner for a day, and you're going to tell us exactly what you'd like to see in this retail investment package. Before that, let's discuss another really important set of issues which Tatiana mentioned, which is the listing. I think it's going to be packaged with prospectus and market abuse. There's going to be a package of important measures. Tatiana, tell us about this as much as you can without giving away the state secrets. Is it going to be easier for smaller companies? Is it going to be less bureaucratic? Are we going to get rid of a lot of flotsam and jetsam, as we say in English? Is it a simplification exercise, or what is it?
Well, David, I think, to be honest, it's not worth it if it's not about simplification and alleviation, because the problem with the EU laws that they've been built over time, and the intentions were always good, but I think time showed that some of these things actually turned out to be a bit of a burden, if not to say more. So I think the intention is really to have a critical look, but a critical look without forgetting, what stakes we have. So obviously, prospectus rules are there to protect investors, so we need to ensure that investors remain to be protected, that they get the right information. But at the same time, we need to be asking ourselves a critical question: is the information that they're getting today in, an 800-page prospectus, is the information they need? And perhaps the answer is no. And if the answer is no, what can we do as the Commission to alleviate the burden? And where the burden actually comes from? Does it come from law, as it stands today, or does it come from, for example, national authorities sometimes requesting additional information, even if, let's say, EU law does not require that? So it's about us asking these critical questions for different types of companies. So I said the main focus remains to be SME, but I think the problem exists also for larger companies. And therefore, I think the approach needs to be overarching. Ourselves asking the question, does it work on regulated markets? Does it work on SME growth markets? Does it work for, IPOs? Does it work for secondary follow-on issuances? And I would hope that our proposal would be deemed fairly ambitious. Of course, we still need to come to a definitive view, and we're going through our own impact assessment internally. We need to make sure that we assess the impact properly before we come out. And this is the intention. On market abuse, of course, it's always a very sensitive question. Guillaume was mentioning the issue of PFOF. Market abuse, you never get, an emotional member states if you start talking about market abuse, because in many cases, the moment you start touching upon market abuse regulation, there is immediately this fear, okay, you're interfering with market integrity. And that is, of course, not what we want to achieve. But again, the question is what we have today really is the most efficient way for us to get to the outcome of market integrity that we want to achieve?
So tell me, listening to you there, are we going to have you're going to put forward a regulation here in order to ensure a more homogeneous application of the rules? Are we going to have direct listing? Are you going to say something about different voting systems in the directive, or am I probing a little bit too far here?
Well, you're probing just the right way. These are all the considerations that are currently on the table. Indeed, we are looking at legislative changes, because law can only be changed with law. amendments to the prospectus regulation, amendments to market abuse regulation, looking also critically into old pieces of law like listing directive. Does it make sense to have something that is largely outdated or not? Perhaps it still makes sense for some. So being cautious also about it, because you don't want to have unintended consequences either. And yes, looking into other elements, that may render issuance, particularly, on regulated markets or other markets, more interesting for some groups of companies, like high-tech companies. And indeed, we have been asking questions in our public consultation about a possibility to, introduce a possibility for all companies to list based on multiple voting rights. The discussions are still ongoing. The jury is still out, so I cannot tell you what the outcome is going to be. But yes, those are all elements on the table.
I've got some very good questions here from Sabra Kadi, but I'll come back to those. First of all, Anthony, how are we going to revive IPOs in the European Union? They're going down. One of the questions from Sabra Kadi is, we saw in the past European companies choosing to go public. For example, she quotes Spotify in the US. So do you think these types of changes that Tatjana has been hinting at are going to do the job? Are we going to be able to, this is sort of strategic autonomy, isn't it? I mean, we want these companies to be developed and financed in Europe. Is this going to do the job?
Look, I think you're completely right to talk about strategic autonomy, strategic sovereignty as well. Shortly after Brexit, the UK regulator, the FCA, has adopted a series of measures to commit to simplify the listing landscape, modernize it, and bringing up to speed, because they realized that they lost some edge after Brexit. And we saw that, by the way, by having a lot of non-domestic international companies knocking at our door to do IPOs in Europe, whereas before they would have done it in the UK. Now, what the FCA did, the first thing they did is to introduce a mandate or a mission statement for themselves to say that they need to check that their measures contribute to the competitiveness of the UK as a financial market. I think this is really important, because this is exactly how we should look at it ourselves. And so today, when you talk with the potential issuers, the barriers to IPO that they see are about fragmentation. They still see differences of practices, local implementation, gold plating, national competent authorities practices that are heavy. They see that. The second thing is they see some cost associated to some of the provision of market abuse, for instance, and also they see complexity. So the Listing Act is a unique opportunity if we act fast and if we act in the spirit of simplification that we just talked about, to fix a lot of these things, and doing three things. One is to promote the access to European capital market for international companies, so that they don't go to the UK, they don't go to the US, because we have investors. The second thing is to retain European companies that want to go public, and so that they list in Europe. And the third thing is to promote the access to SMEs to capital market, whereas today the temptation to go for a third or fourth round of VC or PE financing is there. Yeah. And so the Listing Act should contribute to fixing that. And I just want to talk about three elements, but it's about the standard prospectus that is not more than 300 pages. It's in English. It's just about what we need, not about what we think we need. Some countries still look at the business plan of the companies. This is not what a regulator should look at. The second area is a supervision. Without advocating for a central supervision, because I think maybe it's overshooting, but we believe that there should be some check and balance or peer review to make sure that the supervision of the listed company is practiced in a harmonized manner everywhere. And maybe the third element is market abuse. SMEs complain a lot about that. It's overshooting. We need to adapt it to the SME growth markets.
No, I agree. I very much agree with what you say. Ondřej, before this panel started, I was talking to the chairman of FESE, who comes from your country, and he was telling me about a tremendous young prospect, which is just, I think, listing on his exchange in Prague. But would the rest of Europe know about this? I mean, isn't this one of the problems? We've got these tremendous companies, but somehow we can't finance them. They get frustrated. They need a new development capital, and off they go to the United States. And we've seen that time and time and time again over many, many decades. So how do you see this? Well, what do we need to do here to keep these prospects in Europe, to build up these into world-beating companies?
I think many of the points were already mentioned here, and I cannot disagree, because I think those are the right spots and the right points to address. The key issue is actually to make sure that we are actually progressing in creating harmonized approch. We are still speaking about union of capital markets, which is actually built on the fact that we have a single market in other areas of economy, and I think this is important, because obviously if a company and I think now we discussed that earlier, this will be more critical than ever. If, let's say, the US will recover faster, like it was back in 2009-10 from the crisis, or the impacts on the US will be much lower, we will see more and more companies actually going and looking for the capital there.
Sure.
So we have to act fast, because I think the urgency is there. But I think the key, in my view, is, on one hand, it's really about creating this common European investing culture, which means, on one hand, there is a more harmonized environment for companies, and this, in my view, is actually the direction of travel of the Commission proposal. And I think, and I can fully support that, because this is what we need. And also, I think we should really open also these difficult questions where the member states have their own national competencies, and they don't want to move out, just to make sure that this is actually helping the entire market and those member states as well. I fully agree with the proposal to have a prospectus in English. You know, this is something that it can be actually very small thing to start with, but it can help, you know, in many ways. The same as accounting standards. I think those are small things, but you know, the companies are actually dealing with them on a day-to-day basis, and they are actually in the end complicating. And last but not least, I think it's really also about, you know, a lot of awareness raising, a lot of information sharing. You mentioned activities in Prague are not known anywhere else, but I think it's more the fact, you know, of educating entrepreneurs that they can actually reach out for capital, looking for cross-border opportunities, and on the other side also educating potential investors, especially retail sector, to look for their investing opportunities also in other member states, and that those opportunities will be credible, trusted, they will be fully protected, but they will offer what they look for. And I think this is the key area where we have to actually focus our activities on.
Very much agree. Before we go to put Guillaume in the hot seat on the retail agenda, one question here for you, Tatiana. Again from Sabra Kadi. She's saying, why are we not taking bolder steps, such as a 28th regime for insolvency, taxation and corporate law, which she says could be a really big step forward? Why aren't we doing that?
Well, the reason is because it is difficult.
But life is difficult.
Life is complicated, yes. But certain things, and I think with time I realize it more and more, actually stand a bigger chance of success if done incrementally. In certain areas where we had a crisis and we were successful in banking on that crisis, you know, we did major things like the ESA's review, you know, single supervision, which was great. But we only managed to get there because we had a financial crisis. right? So here we don't have a crisis on taxation, on insolvency. You know, there was talk of many companies lining up, you know, and being potentially bankrupt in the aftermath of the COVID crisis, but it did not materialize. So as long as you do not have that situation, it's very difficult to move with something big. Plus, personally, I am not convinced that the 28th regime is always a great idea. Because I think 28th regime is a second best for harmonization. Because what it does, it introduces a second parallel sets of rules. And now think about taxation and solvency. You know, parallel sets of rules on something which is very complicated and very national.
Yep.
So instead of going in parallel terms of creating something, and it works in certain cases like products, labels, so you can create a product like PAP, I think that probably is a good concept there, but it doesn't work when you want to actually approach rules, you know, make them work a bit more similarly. In this case, you need to go by the harmonization route. And this is what we're doing.
I see, before we ask Guillaume about the retail, I mean, I see the Commission sort of subtly changing the language about capital markets union. It's now an investment union for sustainable finance. Is that deliberate, or is this a subtext? I mean, I've heard this from the French presidency that we should relabel it. Capital markets union doesn't sound right. It should be an investment union for is this, or am I reading too much into it?
I mean, as long as it quacks and walks like a duck, it probably is a duck, right? So I don't think it matters really how we call it. I think what matters is really what we do, you know, and what the result of our actions is. So let's call it investment plan, and it will be investment plan. Let's call it sustainability strategy, and part of it will definitely deal with the sustainability. But ultimately, it's about single market. It's about integrating our capital markets.
Fully agree. Now, Guillaume, I know you've been patiently waiting here, so I'm putting you as the commissioner, and I'm asking you, a commissioner saying to his services, these are the 3 or 4 points I want in the retail investment strategy. What are they?
Yes, but first I wanted to react to the very interesting thing that Tania said on the banking union, that it works because it came out of a crisis. And that's exactly what Jean Monnet was saying decades ago. European Union will advance only through crises. I hope you remember what I said up front, but when you have inflation at 8, you have bond interest rates at 1, minus retail fees, which are on average quite high, minus taxes. If this is not a crisis for pension savers, I don't know what is. So we are in crisis mode, so I hope we get the investment market union, if you prefer. The French prefer it because, you know, there are some ideological, sometimes interpretation of the first word. But so I would love to be in the seat of the commissioner, so especially for retail investors. So in fact, first thing is that I fully endorse the 5 key objectives of the retail investor strategy set up by the Commission and therefore by the Commissioner, which I would like to recall to everyone. First, to have a more coherent rule book across the various categories of investment products. Second, and I'm quoting the Commission, because I'm the Commissioner, I should not make mistakes on quoting my own objectives, right? So adequate protection, that's the number 2. Bias-free advice and fair treatment, that's the number 3. Would have maybe put number 1. 3, open market with a variety of competitive and cost-efficient financial services and products. And lastly, transparent, comparable, and understandable product information, especially key information. How to do that is where sometimes I might have slight divergences, but not so many in terms of action. So if you take a more coherent across the board regulations, I think that is really needed. We talked for decades about the silo approach, you know, rules for securities, rules for insurance-based investment products, rules for crypto investments, rules for crowdfunding investment. I continue. So no, when you are at the retail point of sale, I can tell you, people are offered at the same time many or all of these products, and the rules are too different. And I think you kill two birds with one stone as focusing on that. And that's the first objectives. If you read the public consultation on the retail investor strategy of last year, that is the first objective. The second, first, so you harmonize investor protection rules, you harmonize conduct of business rules, distribution rules, but also that is a very important thing to start going through to bias-free advice.
And how are we going to do
but
that?
realistic.
How are we going to do that?
Exactly by doing, looking at the first objective I just said, but not doing it, which means, and this was proposed not by retail investors, as Tanya knows well, but by this high-level forum on the Capital Market Union of 2020, which was mostly composed of industry people, is to harmonize, taking the best-in-class today, which is the MiFID rules, especially on conflict of interest, on product governance, on categorizing clients who are more expert in financial items, etc. And so that means to expand especially the rules on conflict of interest. And so that will go a big step towards this objective.
Would you include in that robo-advice, robo-techniques, provided they were licensed, authorized by the regulators? Would you?
Of course, robo-advisors are fully included. And in fact, they are already. We are doing every year a research on robo-advisors. There are a lot of problems, but one we didn't find is that they would be unlicensed. They are licensed either investment companies under MiFID, and sometimes also as asset management companies, because when you do asset allocation practically, you fall into that. So it would apply to them. The key thing is that MiFID is only about less than 20% of households' financial saving. So if you ban inducements for independent advice, like in MiFID, if you ban inducements for portfolio management, so they are not paid twice on what they do, but this applies only to a small pot of savings. You have to, again, harmonize and address the 80% remaining. One additional thing from the HLF-CMU from 2020, which is also, in my view, feasible, at least the HLF-CMU felt was feasible, is to ban inducements, so sales commissions, because that's what they are, on execution-only investments. By definition, an execution-only investment, there is no advice there. So why the intermediary would get a commission every year, because these are trailing commission, for something where he had no advice to give. And this, as you hear me, I'm not advocating, because I have grown too old, I think, and too realistic, a full ban on inducements like in the UK or in the Netherlands, but this very reasonable, practical approach from the HLF-CMU, again, which we endorse fully, and which I would like really the Commissioner and my neighbor to listen to again. I know my neighbor listened to it quite a number of times, but, repetition is important. On the cohesion of regulation, there is one piece missing currently from the commissioner I am now replacing, so I will add it. There is an incoherent piece, which is the recent directive on collective redress for consumers. Yeah. That's great. It was long awaited, but the current commissioner, and I endorse again, one of the key objectives I said of the Capital Market Union, of the retail investor strategy, is to enhance the participation of retail investors into capital markets. So tell me why this directive, despite all the efforts of Better Finance, is excluding retail investors in listed shares and bonds from the benefits of the collective redress directive. So this is very urgent to amend and to make it coherent with the CMU. And the last thing, because I talk too much, as you know, but as commissioner, maybe I get some extra minutes. The last point, so two last points. I quoted the open markets with a variety of competitive and cost-efficient financial services and products. we would like to have access to these products. We don't, because they are not promoted, offered at the retail point of sale. And I would like to give you two short examples, because that will really, and it's related to our discussion on capital market, on bonds. Since 2015, the share of listed bonds in the portfolio of retail investors has collapsed, minus 40%. Where at the same time, interest rates got lower. We were de facto excluded from this market. So what is left for us? Packaged bond products. 1.9% average fee, ongoing fee on products that deliver what, 0 to 1. Many reasons, but many regulatory. The issuers are asked to produce a KID in addition to the summary prospectus. And as Anthony was mentioned, gold plating. Some major member states, like east of France, for example, they put the unit of bonds at 100,000 euros. So, of course, almost no retail investor can buy it. And at 100,000 euros, thanks to the prospectus regulation, no summary prospectus. Thank you. I could give you more examples, so I finish on the last objective of the Commissioner for Retail Investor Strategy, which is to have a comparable, intelligible key information. That is really key. It's been long awaited. The PRIP-SCID regulation was initially due to be reviewed in 2019. I would add there is a lot of misleading things there. If you really want, and that relates also to digitalization, if you really want, especially the new generations, to be able to compare products, investment products on their smartphone, there must be comparable information, intelligible, and relevant. Today, they don't even know if the product has made any money or not, if it has beaten inflation or not. I'm going back to my initial point, and I refer you to a very interesting document from FSMA stakeholder group published last week on inflation and investor protection. There's a long way to go. We don't even know if the product has met its investment objectives or not.
It's quite a big agenda. I think...
I have more, but I stopped.
Tatjana's taken good note. Now, turning to you, Anthony, I mean, how do you see this? Is this a debate really about the architecture of markets, or how are we going to get responsible, good, much bigger retail investment into our capital markets, into our exchanges and so on? How are we going to do that?
Right. And maybe we can dream also to capture the flow of retail investment on cryptos back to the equity capital market. That should also be one of our objectives. At least that's what I believe. But in all seriousness, I think you're right to talk about architecture. A few numbers that I think you guys know very well. But since the end of the COVID crisis, we've seen a decent number of retail participants on secondary market on exchanges of between 3 and 4%, which is better than before. But we've also seen something quite interesting. Most of the IPOs of let's say mid-cap or SMEs have been largely oversubscribed by retail. Because people care about what's in the prospectus, if they can read it and if they can analyze it. They do care about the story of the company. They want to be part of it. And I think this is important. We need to keep that in mind. And so today the issue is not really the access of retail to their national market. Is that retail cannot access an IPO from another country in Europe. This is too complicated. It's too expensive, and it's easier for them to buy an ETF, right? That covers a certain sector. And so, talking about retail and CMU for me would be first of all to find a way to provide access to all the listed companies for any retail in Europe. This is extremely difficult, but this should be one of our ambition, right? Retail care about price formation because they don't want to pay the wrong price for an asset, and so talking about architecture means also talking about the way the price formation is transparent and is explained to them. So it's about MiFID obviously, but it's also about education, and that's important. I think everyone agrees with that. Also, more and more, the link between the retail and the company that they invest on needs to be reaffirmed and strengthened. So I'm talking about governance, voting rights, being able to influence the decisions of the company. And here the ESG topic is back on the table. But you do have a lot of companies where they having a shareholder identification is extremely complicated, and here this is about post-trade, right? And we have not talked about that because there would be a whole other panel. But today, when you want to connect a listed company and their investors, in some countries it's extremely complicated
and expensive.
Yes, and very expensive, obviously. So yeah, that's all I wanted to share with you. Obviously, the payment for order flow is something that I believe is extremely toxic. We've seen it in the US, where retail investors have become not one of the quality flow that creates the right price, but they have become the victim of a slaughterhouse, because everyone is competing to buy this flow, and then you have the incident of Robinhood and GameStop. So I think we need to be independent from the US view of the world for sure.
Well, we've got a few minutes left, and I'd like to ask Andrea and Tatiana about whether the classification of investors, our classification of professionals and retail. I mean, is this too clunky? Do we need to adapt that to I don't know, experienced retail investors, or is this holding us back, do you think, Ondřej? Holding back retail investment?
I don't think this differences between retail and professional investors are the major obstacle, as long as we actually take this properly into account in the legislation. So that which would means that there is for instance not a specific barrier to access, but you have different investors protection mechanisms that will kick in when it comes to retail investors or when it comes to professional investors, because obviously they can handle different amount of risk and the different nature of risk as well. But I think, it has been mentioned here, we already have MiFID rules where we have some ideas how to deal with it. So I think it's more about it. But I think to follow up what Anthony has just said, I think it's about accessibility as well. The professional investors, they are able to look for various opportunities. They see the opportunities the retail investors at this point are not able actually to ever get to it. And it has been mentioned, the young generation is actually investments heavy. I mean, they want to invest into especially long-term products, because they are not sure about what will happen with the retirement pensions, etc., etc. And we see it exactly in the crypto area. It's extremely simple actually to invest. They can do it on their way on the bus from school or from university back home. And this is not what you can do as a retail investor when you invest in other products. And I think that we should actually think of how to make this attractive, how to make it actually fit for 21st century without compromising the investor's protection, without compromising, but actually use the potential of the digitalization and the tools that we have to broaden the offer, to facilitate the access and actually get people more attracted to it. And I think this is also part of the task.
We've got massive savings in Europe, and an awful lot of those savings don't end up in Europe. They end up financing companies in other countries. And nobody's saying there shouldn't be a flow of capital, but what we want to see is far more of that capital being deployed efficiently in the European Union. Now, Tatiana, to finish us off here, is this a sort of classification problem on retail? How do you see this? What are the key points for you? And then we must close.
To be honest, I would have to agree with Ondřej. I mean, this is one element of a much bigger problem, much bigger issue. And I was listening to Guillaume with great interest. He said lots of things that I would say if I were him, because it's a complicated area, retail, honestly. It's as much about trust, about information, about education, as it is also about protection. But then if you overprotect, and I think, some at least argue that in certain cases we probably got to that point of overly protecting investors when they actually no longer have access to the products that perhaps could be even better suited for them. I think we need to tackle all of those elements. As regards investor categorization, I think it's largely about really adjusting law and getting the right treatment for the right category of investors. So those who know what they're doing, who have experience, who feel comfortable, who understand risk, because this is important to understand risk. And sometimes when people invest in crypto, they don't fully understand risk. But I think the idea is good to stimulate the investment culture and equity culture. But if they do understand all of those things and have experience, I think they should be treated adequately and not like, a 75-year-old lady who just went to the bank and asked what kind of product she can buy with her pension savings. So it's a different story, I think, and I think it's our responsibility and objective to make sure that the rules work in all kinds of circumstances and for all groups of investors, that we do not overprotect, but also do not underprotect those who need protection. So it's about getting the balance right.
No, I think that's right.
And not necessarily changing the rules entirely. By the way, David, if I may say, one thing that we haven't mentioned is pensions today.
Pensions?
Yes.
Yes,
pensions.
I know.
Because this is where I think we need and can do more, and where we have a lot of potential to actually bring in those savings to.
We've got to make the PEP work.
Capital markets.
Right.
PEP, auto enrollments, does work in the UK. That's what we see. They
I think that's
increase
right.
their coverage rate quite incredibly over the few years.
Huge amount of capital.
Absolutely,
the markets.
absolutely. So more to be done.
Well, we're going to have to wrap up. You said also something there which I know the Commission is very keen on, which is investor education on financial. I mean, when I was at school, we learnt, Latin and gymnastics and, I hesitate to say cooking, but I mean, we just don't teach people about we have a demand side which is, just simply not well educated enough. And I think the really smart countries are going to be the ones that make this mandatory in the school curriculum. I just don't understand why we don't. With the aging Europe, people are going to have to take more and more control of their financial life. So for goodness sake, give them the tools to do the job. And I'm sure the Commissioner will be coming back to this in her retail strategy. So let me thank you all very much. Whenever I have these panels, we have far more in common than not. We wish the Commission, European Parliament well. Just press down on that accelerator a bit. We've only got less than 2 years to go. So thank you all, and both to you, Anthony, and Guillaume. Thank you very much. So we're going to take a very quick break, a minute or two, before Rainer takes us through the rest of the day, a fireside chat with Jan Sijsens, a colleague, Tatjana, and David Nunes. Thank you very much.
Thank you.
And here we're back. I think this was an excellent panel moderated by David Wright around Capital Market Union, and certainly discussing some of the important topics like how to make it easier for companies to list, how to, I think, empower end investors to be more active in capital markets. We will add another dimension now with digital transformation, which obviously I think is also an important part of Capital Market Union for me, because certainly we're living in a digital age, and for us technology is playing an ever greater role. So let me visit Jan Sijsens, Head of Unit Digital Finance at DG FSMA, and David Nunes from the 6th Digital Exchange, and I think the first exchange dealing in digital assets in Switzerland. And I think it'll be probably an interesting debate because the panel is trying to develop, or the fireside chat here, a bit, I think, the difference between what we're trying to do in Europe in order to accompany that digital transformation with a regulatory framework that I think protects investors, that gives order to what sometimes seems a very orderly market, especially in those highly volatile times. And on the other hand, how to maybe build a bridge to existing infrastructures to bring some of this into the light, and how we're competing in the global scenario, because certainly Europe is not at the forefront of the digital transformation. Sometimes we're lagging a bit behind. We're trying to catch up. So I think it will be a very, very interesting debate here to sort of see where is Europe positioned and where does Europe need to move. And maybe, Jan, I would ask you to probably give us a bit of the insight what the Commission has done. And I think there's quite a lot of regulatory files that have been discussed and I think are about to be finalized, especially MiCA and the DLT pilot regime. So the floor is yours.
Yeah, thanks. Thank you very much, Rainer, and thank you for having me. This is indeed also a topic which suits quite well to the discussion you had a minute ago on the Capital Markets Union, because I think in some instances, actually, digital technology is doing more actually to integrate markets, to allow investors also to shop around across borders than actually we could ever have done with legislation and with the tools we have here in Brussels. So this is really very much, I think, a direction, or let's say a development which we also see as an opportunity, both for integrated capital markets in Europe, also for regional capital markets, but also indeed for European investors and citizens. Now, it is digital finance is not without risk. On the contrary, so I think we have early on embarked on an agenda actually to try to to harness the opportunities for Europe, but indeed to regulate the risks properly. And really, those are two things which actually in this area go hand in hand. So this is not an area where you have a trade-off, I would argue, often between, let's say, regulation and innovation. But really, the innovation we are seeing, very often you can only scale it up, you can only actually make it accessible to a larger pool of people if it is properly regulated, because only then mainstream investors, only then institutional investors can and should also probably engage into it. And that's, I think, a bit what we are trying to achieve. So I think we just recently had an agreement on the Digital Operational Resilience Act, which is really the basis to make sure that the digital risks, cyber risks, are actually addressed in this area. And we already have the DLT pilot actually agreed, and it should be very soon be published. Actually, in the coming days are here, which will allow some experimentation within the existing framework. And then we are now still, of course, working on the markets and crypto assets regulation, which would try to create a common harmonized framework, also a passport across Europe for those crypto assets which are not covered by the existing regulatory framework. So we hope to also make very good progress on that one in the coming weeks, and then have been doing or are doing, hope to be doing our bit to indeed enable these markets to further grow, and really also support all those companies who are out there and are really doing quite fascinating things actually across Europe. And that's, I have to really say, I also am again and again impressed what's happening in Frankfurt and Paris, but also what's happening in many smaller cities in the EU here. This is really also something which is another opportunity also for local capital markets, this trend, the digitalization. So yeah, I think quite some positive prospects around, but it's clear a regulatory framework, as proper and sound one, is necessary and is healthy also for this market to develop further.
Now, David, maybe coming to you, when I think about crypto or digital assets, I probably think much more than the EU and what Jan was talking about some island in the Caribbean with some probably not so strong regulatory framework. I think about unregulated, I think about fraud. So this is probably what comes to mind when thinking about this crypto or digital asset sphere. And I think you're in Switzerland. The Swiss are not known for unregulated, but you're outside of the EU. So tell us a little bit, how do you see that bridge between, I think, classical market infrastructure, digital assets? Where's the world developing into?
Thank you for the question. So, from my perspective, well, we as SDX, we kind of emerge from the sort of regulated standpoint first and foremost. So, on the digital security side, and I think it's important to make that distinction, and it clearly is made from a regulatory perspective, between cryptocurrency trading and crypto exchanges and digital securities. SDX is a digital securities platform, a trading platform, exchange and CSD. But we approached the topic, the area, specifically from the perspective of already being a regulated exchange or provide a regulated FMI as SIX group. So SDX was always going to be sort of emerging from that space first and foremost, rather than sort of crypto native approach of sort of maybe benefiting from some a degree of greyness around regulations, which we've seen on the global scale, not so much though in Switzerland, where crypto exchanges are regulated. But we, as SDX, approached this from the perspective of we'll get a license to operate a central securities depository and an exchange based on distributed ledger technology, but we'll get that via the existing FMI regulation. So the same regulatory standards or same regulatory licenses that are the traditional exchange SSX and the traditional CSD SIS has are the same licenses that that SDX acquired in September of 2021. So on the security side, not only is it the case that the existing securities framework within Switzerland, the legal environment there, but that already provided a pretty highly developed framework for distributed ledger-based assets. So intermediated securities are a proven legal framework which can be applied in the context of a regulated CSD, and the Federal Act on Intermediated Securities in Switzerland enables CSDs to create intermediated securities on a DLT. And the tokens then are linked to the assets. So the holder of the token is the rightful owner of the asset, and trading of tokens triggers the exchange of value and ownership of the underlying asset. So the benefits obviously you get from being an FMI in this particular context is we can introduce mechanisms to intervene in the case of mistakes and mistrades and loss of keys, and that allows to sort of eliminate the disadvantages of distributed ledger technologies, where people do point out those particular aspects as being big concerns, while at the same time harnessing its benefits. So very much enabling our customers, our members, to enjoy the benefits of distributed ledger technology, while at the same time doing it from within a regulated framework.
Now, maybe if digital assets in the EU would also fall under MiFIR. So I think that was a broad debate we had about 2-3 years ago, for example, in the EU, and I think that was the decision taken quite prudently also by the supervisors. I personally sit in the ESMA stakeholder group, and we had a lengthy discussion about that 3 years ago, but still, I think we just 3-4 weeks ago, we had a discussion in the ESMA stakeholder group around MiCA, and I think the general sense there was, well, it's the right step at the right time in the right direction. However, I think there was the feeling that still, in terms of investor protection, how easy it is to invest in crypto assets, for example, or digital assets domiciled outside of the EU, how easy it is with a fingertip of a smartphone. Is it enough? And what else can we do to protect the end investor? Should we do more to protect the end investor?
Well, I would first of all say we are moving into a whole different area and a whole different regulatory situation with MiCA. I think that's maybe still underestimated today. I mean, let's face it, today there are only a small number of member states who have indeed, let's say, rules in this area in the first place. In many member states, it's completely unregulated, so you can do and not do whatever you like. And even there, where you do have these rules, indeed, let's say it is they are quite limited and quite punctual, basically. So, I mean, with MiCA, we will have, let's say, all the key concepts from MiFID, whether that is on the advice, on the appropriateness assessment, suitability assessment, and all the rest of it, basically, all the rules which you know very well in a proportionate manner. So that will be a big step, and I would very much expect the whole ecosystem to then indeed let's say, to be a watershed between those who will grow into compliance basically and will be compliant, and others where it will then be more and more difficult to operate. And that's then, of course, also the role of the supervisor at that moment in a way, as it's always their task in a way, yes, maybe to work with those who want to grow into an authorization, but also then to clamp down on those who are doing active solicitation in Europe without a license. And I would expect that to, it is already happening today, but to be really still much more active. I think we also in MiCA are looking to really enhance the rules indeed on active and passive solicitation in a way, to have clarity there. I think that is very important. Now, one thing we cannot change, the fact that the internet is accessible by everybody and that everybody on the internet can access firms not only from Europe. That is not something we can change in ourselves, and we can have MiCA 1, we can also have MiCA 2 or 3 or 4, but this is a factual, let's say, element which we cannot change. So in my view, therefore, the right approach is maybe not to already think about what should be the next set of rules, but it's really the international cooperation, and that's what we are strongly pointing at. I mean, in the end, we will not be able from Europe to regulate the whole world. We will also not be able to prevent our citizens to access products from elsewhere if they really want it in this little space. So we need to work with the other jurisdictions to make sure that indeed everywhere there's a minimum standards, that there's supervisory cooperation, so that if you really have the impression somebody is kind of actively marketing in Europe without the license, that you can do something about it. I think that's, for me, the way forward. MiCA is a good step, and then we really need to enhance the international cooperation, and I have the impression that the Swiss government, the UK, the US, they're all on the same line. So I would have quite a hope that this can also materialize.
Now, David, maybe to you, you talked about digital assets. What about crypto? And bringing that probably into the regulatory fold could be an interesting thing too, especially thinking about MiCA here in Europe. I'm not sure, is there any thoughts about that in Switzerland? And secondly, what do you sort of see as the benefits, I mean, really for the end user, the end customer? What is possible in SIX digital exchange that's maybe not so easy in the traditional infrastructures?
So, it's an interesting question. So the venues are regulated in Switzerland already, which I think is obviously a very good start, because it's exactly that which we're referring to here in terms of the entities that are going to be selling and marketing and selling their services, and whether or not those particular those venues actually are providing the appropriate sort of degree of investor protection through the rules that they're actually applying and through the controls that they have internally. So there is already a framework around getting regulated as a crypto exchange in Switzerland. I would make the point again that STX is not a crypto exchange, and we don't have that particular sort of regulatory status ourselves.
And probably the question also how to get money in and out, any money laundering, source of funds, etc. Is that a particular concern, or?
For us specifically, or for the market in general?
Well, for the market in general, and to potentially bring it on exchange.
I think, again, so it's the same requirements around AML KYC would be appropriate for venues who are providing those services in crypto. So you understand who the ultimate beneficiary owners are of these particular, where the sources of funds are coming from. I mean, it is worth noting, and I think that this is it's probably not. You can't say this enough, but in terms of when funds are on chain, so when funds are actually in crypto, then you're in a world that is far more transparent than the traditional financial space. And you try and track a set of SWIFT messages as they move backwards and forwards between various parties, and you very rapidly lose the ability to track where particular funds are coming from. I mean, on crypto, on chain, those funds, so a particular coin, you can track which wallets that has been to with complete and utter clarity, and you will be able to do so forever. So from the point at which that coin was originally minted or burnt, or minted or mined, to the point at which you received it yourself into your wallet. So there's actually a lot of, I think, benefits that crypto can bring to the whole AML space because of that degree of transparency. And you're probably aware of the various sort of Bitcoin-related ransomware attacks, where the funds that were provided as part of the ransom in most cases would track down relatively easily because of the level of sort of sophistication of the tools people use to track things on chain, but also the fact that this is available because you have the distributed ledger, which is a this permanent copy of that particular of the origin of the transaction of those coins and where they're going to, what wallets they're currently sitting in. So it's a kind of on the one hand you have the challenge that historically absolutely crypto has been used for money laundering and for sanctions evasion and so on, but there's also some significant upsides around the transparency of these protocols, or the technology more generally.
Yeah, and just about maybe the digital asset space, what is sort of the value that you think you're really creating for customers as compared to the traditional infrastructure? So that's
where we get into sort of what exactly can we achieve with DLT. So I think the fundamental difference between DLT and the traditional infrastructure is that traditional infrastructure is very much based upon messages being passed between different parts of a chain. Those messages need to be reconciled. They take time to be received and processed. On DLT, everything's instantaneous because it's simply a record that's being updated, and records can be simultaneously updated in real time. And that's what we achieve with the distributed ledger technology that underpins what would technically be considered post-trade services, but because you now have an indivisible step on SDX between the trading and the settlement and payment, there's no longer this sort of concept of post-trade in that particular chain. So historically, the T+2 settlement of say of a bond, you would have posted collateral at a clearer, you would have had settlement and payment systems, you'd have used middle and back office to reconcile each individual step, and the whole process would have taken around typically sort of T+2 these days, and that's considered to be a sort of major step forward to where it was a few years ago. Whereas with the distributed ledger technology, you can't trade unless you haven't got the funds to actually facilitate the execution of that trade. And as soon as a match is made and there's funds available, then you'll simultaneously have the funds transferred to the seller, and the buyer will receive the asset. So we have completely eliminated counterparty risk and settlement risk in that particular process, with the sole exception of the fact that at the moment we're having to use tokenized Swiss francs, so a stable coin. We can get into some exciting conversations about stablecoin if you want, but we have just about the most stable stablecoin you can possibly imagine. It's considered to be a synthetic CBDC to actually power the cash leg, as it were, on the platform. So if you're a member, then you deposit Swiss francs at SDX, and we then hold those in a one-to-one reserve at Swiss National Bank and then issue tokens.
All right. No, and I think that's really, what the Commission is looking at to harness, the efficiency gains that the digital transformation that really new technologies can bring. But maybe as a final question, looking a little bit at Europe again, if I think about the open strategic autonomy in the digital space, I first think about Microsoft, Amazon, and Google. I really think, there's probably a lot more we need to do in the financial ecosystem, in the digital transformation overall, scaling up fintech, digital infrastructure investments. How can we make the EU into a player outside of regulation?
Well, in my view, first and foremost, this is about encouraging the private sector, which is really at the forefront of technology as well. There is such a thing as a first mover advantages, especially in these digital markets, but elsewhere as well. And I think so the best thing we can do in Europe is in those markets where indeed, let's say, the developments are still dynamic, to be good, to be also open to innovation and to move this forward. Now, it is very clear that, let's say, in some parts of the digital space, indeed, let's say, the market positions are as they are, and it's very difficult once, of course, let's say, cloud services are, let's say, divided up between a couple of, let's say, firms, then to go there. But again, the nice thing about technology is that the technology is changing every 10 to 20 years. So every time, in a way, the pie is distributed afresh. And cloud services or cloud is today the solution of choice. Maybe that's, I think, one of the assumptions. It will be in 5 or 10 years, it will be more edge computing, where most of the data actually sit decentralized, not in a centralized cloud. So maybe on that one, the cake will have to be distributed again. And I think it's important that then next time we don't look back in a way and see the things maybe where we were not at the forefront, but we rather look at ahead and see how can we actually maybe again be in the first row when the next, let's say, technical change comes. On our side, what we're doing to help that is massive funding. I think I just heard today, spoke with one of our experts, a blockchain professor who's really in a lot of projects, who said actually on quantum computing, there's no other jurisdiction in the world which puts there as much public money as the EU. So we are really, with the Digital Europe program, with the recovery and resilience programs, we are really having massive public investment as well in this area. So I think we are doing that bit. We're trying to have a regulatory environment that is conducive to change. We're trying to create the data spaces, actually the standards that let's say even mid-sized operators in Europe can actually work together in this space, rather and combine maybe their data, their technology know-how. I think that's what we can do. But in the end, it's up to business to kind of to do that and to look ahead and try to seize the next opportunities.
And what I think I learned from our chat is really it is probably trust and integrity, and that's where MiCA or the DLT pilot regime provide a good basis. It is innovation, how to rethink business, how we can make it more effective and more efficient. Thank you, Jan. Thank you, David. I think it was a very educational session. I learned a lot, and thanks a lot. And we'll go in a very short pause and then continue with the De La Vega Prize. Thank you. Welcome back. And I think now it's time for the FESE de la Vega Prize, as every year. As many of you know, the prize was created in the year 2000 to encourage research by young scholars under the age of 40. And every year an independent jury and a very distinguished jury awards this prize to an outstanding research paper related to securities market. I would very much like to thank the jury this year to, I think, review quite a lot of very, very hard, doing a very hard work to, I think, go through very good papers. So I think it was not an easy task for the jury. And indeed, the standards were extremely high. Over 2 rounds of evaluation, the jury has come up with a winner from some excellent papers from all over the world. And so without further ado, I'm pleased to announce that the winners of this year FESE de la Vega Prize 2022 are Samuel Hartzman, Associate Professor of Finance at the University of Chicago Booth School of Business, and David Salomon, Associate Professor of Finance at the Boston College Carroll School of Management, for their paper, Predictable Price Pressure. Congratulations to both of you. And we have them with us remotely. And I would give the floor to you now to give us a very short overview of the paper.
Well, thank you very much. And it's quite an honor to win this award. So our paper tries to get at the question, if we see a number of investors systematically trying to buy equities or sell equities, what should we predict about what happens to the level of prices in the market? Now, standard finance has an answer to this question, which is nothing. Basically, if those investors are buying or selling and they're known to have no information, the classic efficient market intuition is that shouldn't move around prices. And that's because, of course, prices should be shifted around by information, not just naive flows. So if you're an investor and if you have no inside information, and you're known to have no inside information, then you shouldn't be shifting prices around. Now, that's in tension with another literature that has shown in certain instances, naive fund flows will shift around market prices. Now, this is a really hard problem to tackle because in most cases, we think people are trading because they might have some sort of fundamental information. So to demonstrate that in certain settings, there are there is this type of price pressure, people have turned to kind of strange, out of the ordinary scenarios, things like index additions or fire sales, places where we know that people are trading for reasons that aren't about the fundamental information related to a stock. So what we're trying to ask in this paper is like, okay, outside of these extreme situations where maybe liquidity providers are stretched, how important is price pressure for the market as a whole? Now, in order to get at this question, you would want to go to a scenario where, first off, there was a naive, uninformed flow. You would want this flow to be predictable, both in terms of timing and in terms of amount. This means the market should understand that people are buying not because of fundamental information, but just because they happen to have more cash that day. We'd like to go to kind of a normal, everyday scenario, because that's what we want to test. In normal times, does the market counteract the impact of these naive flows? And also, if you're a liquidity provider, this should be the bread and butter of what your business is. And then we would like to turn to the deepest, most liquid asset, something like the entire equity market. Now, that might sound stylized, a bit abstract, but we're going to get quite close in this paper. So we are going to look at the impact of aggregate dividend payments on the level of the entire stock market. Now, dividend payment days are days when investors have more cash, and when investors have more cash, they predictably use it to buy more equities. Now, importantly, dividend payments are announced typically more than 40 days before they actually occur. So they're days with no economic news. The tax implications are sorted out way beforehand, and they occur almost every day in the US market. So we're just going to ask, do market returns get higher on days with higher dividend payments? If we can show that graph now, it'd be great. And we're going to find that they do. So what I've grasped here is the crisp value-weighted market return on the y-axis, something similar to the S&P 500, relative to the level of daily dividend payment on the y-axis. So to the left, you can see days with low dividend payments, the lowest quintile, the market earns about 2 basis points per day. Going to that top quintile to the right, the market's earning more than 8 basis points per day. So even though this is stale news, this is predictable news, this is exactly the type of thing the market should counteract. You can see there's roughly a 4-fold increase in market returns going from the low dividend payment days to the high dividend payment days. And that's basically the paper. We go into a lot more detail. We show a lot of robustness. We show this is really about dividend payments, not anything else. Other predictions, when people reinvest more predictably, these effects are all larger. And so this seems to be a widespread, pervasive impact on the day-to-day functioning of markets at the entire market level. Taken as a whole, we think our results suggest that in most scenarios in the market, which are much more complex, much more nuanced, much more difficult to understand than this one, we should take as our null hypothesis that predictable buying and selling, even if uninformed, should be expected to shift around the level of the market. So thank you once again for the prize. It's quite an honor.
Well, thank you, Samuel and David. I think a very interesting paper. It will be the full paper on our website shortly. So thanks again and congratulations. And let me probably wrap up a day. I think it was a quite intense day. I have to say we started with our FESE president and the Ukrainian ambassador. And I think if you put things into perspective, we obviously all are aware those are challenging times globally, but especially here in Europe, where I think we need to stand for our values. And I think it was probably very rightly placed to have the ambassador greet the FESE Convention today. I think it puts things into perspective, but we need to continue to work to fund the economy, to fund the efforts. And as the ambassador was outlining, part of that is to also fund, obviously, the war efforts in Ukraine. I think the commissioner in her speech talked very much about the multiple proposals to build a single market for capital and to overcome the current fragmentation in the euro markets. I thought her plea really for a liquid and transparent market was very convincing, and it was a very, very broad review of all the different actions the Commission is currently undertaking. In the sustainable finance panel, we talked about another challenge of the time, how to develop compatible formats, how to measure the E, the S, and the G. And we talked a bit about the green bond standard and how that standard could, I think, with all the flexibility, with the taxonomy coming in, etc., be really something that contributes to the further development of European capital market. And also, we did discuss a little bit that the recent invasion of Ukraine brought additional risks for small companies, but that really means that the E, the S, and the G, and probably the E in terms of how we supply our economy with energy, has gained importance and why sustainability matters even more. Then I thought Jean-Paul Servais really gave us a very, very passionate speech about the efforts here in Belgium on financial literacy and how to develop, I think, a better informed end investor that takes literate decision. He said we need to ensure a green, digital, and inclusive economic recovery. We need to make the EU a safer place for individuals to save and invest. And we need to have a very clear strategy in the retail field. That was also discussed in the Capital Market Union panel, where I think we debated really the action plan and how far we have got so far under this legislative mandate. We also discussed on that panel the SME access to capital markets and how that could be further promoted, Listing Act, IPO costs, and so forth. And I think we had a very, very interesting discussion there, how to create a unified investment culture across Europe, because certainly financial education, Jean-Paul mentioned it, but many other things we're really investing into. Probably the direct equity investment, the direct bond investment is very often discouraged, and where people are hoarded into packaged products, but where retail investors probably have the best protection if they go to open public markets at competitive prices and are able to have comparable financial products. So certainly there is a lot to do to reach a bias-free advice, and I think that's where we probably need to move there in the industry. In the digital transformation fireside chat, we highlighted a little bit the crypto and digital asset worlds and where regulation is moving in Europe and probably where we're at the global scale. And last not least, again, congratulations to the De La Vega Prize winners for, I think, an outstanding paper. So I think it was a day filled with quite a lot of content, a lot to process. Let me once again thank to all the speakers across the afternoon. Let me thank our sponsors of the afternoon, Euronext and Börse Stuttgart. And of course, all of you watching. We'll be back tomorrow morning at 9:30 CET. And there we'll go into the MIFIR deep dive, which I think will again be very content-filled around market structure and around consolidated tape. So I think a lot of debate tomorrow to be had. Looking forward to see you tomorrow at 9:30. Bye-bye.